Doom afternoon, everybody, and welcome back to the Doomers News Network, where we don't put a positive spin on all financial news. We just tell it how it is because somebody has to. And I am here joined, as usual, by my fellow Doomers. I've got Travis, and Miss Melody Wright is here with us today. And I am going to turn it over to Travis, who is going to tell us all about this wonderful show that we have lined up for you guys today.
Yes, first and foremost, guys, if you were on X, I'm sorry for the delay. We had some technical difficulties on Melody's end, but that's been fixed now. We're going to start with the first story being This Week in Doom, and then our second story is going to be by me, and I'll be talking about the housing market. Third story is going to be by Melody. She's going to dig in deep on what's going on with China. I'm excited about that. Fourth story is going to be, this one's crazy. I love this one, actually. This is one of my favorite. Jack's going to go into how spineless the Fed and central banks are. And then we're going to end today, basically not really a story, more of a roundtable discussion on whether or not the recession's over. And I have some data points to go over. I might play devil's advocate and just say, no, just buy, look at the stock market. There's no recession. So we'll see how that goes. But I am excited to be here. Happy Sunday. Thank you guys for joining us. Don't forget, you guys, comment below. We will post your comments. And other than that, oh, you're okay. I see what you're doing over there, Melody. All right, guys. Well, I'm going to give it to Jack for This Week in Doom.
All right. Thank you so much, Travis. And I just love to start every show like this with This Week in Doom. And I am going to need you to share my screen, please, if you will, Mr. Travis. And there we go. And look, guys, most of the doom started this week across the pond in China. It was a particularly doomy week for the Chinese, starting with this one on Monday. China regulators tell some rural banks to renege on bond trades. There has been an absolute stampede into the bond market in China as the housing meltdown has begun spreading to other industries, and everybody is worried about a big-time deflationary recession, and they're also expecting the bazooka of liquidity from Chinese central banks any day now. It hasn't come for several years, but everybody insists it's just around the corner. And so everybody's been piling into bonds, and now China is worried about something like happened here in the United States with the bank failures in 2023, where we had this lopsided bond trade. And on Monday, they went so far as to tell some of their rural banks to just outright not settle trades for some bonds that they had already bought. Just basically kind of say, do over, take your ball and go home. You're not allowed to do that. An unusually heavy-handed approach, even for communist China. And of course, we had more bad news from China this week. Foreign investors pull a record amount of money from China. $15 billion of foreign investment cash fled China in the second quarter. That is only the second negative number in history. This data goes all the way back to 1990. It's only happened one other time, and this is the largest negative number ever. Once again, everybody can see the writing on the wall in China. The collapse on the housing sector is spreading to other sectors, and so foreign investors are pulling their capital from China. And we got one more bit of doom in China. Chinese convertible bonds are rocked by once unthinkable defaults. We've had a wave of defaults in the bond market. Convertible bonds are basically bonds that can be exchanged for equity in the company. They were once considered safe havens, easy returns, and now they're starting to see some defaults. Not a huge amount of defaults, but a lot of these bonds are trading at very distressed levels. And interestingly enough, these defaults in the bond market in China are not property developers or real estate related companies. They're companies like China Grand Automotive, companies like Blue Dawn Information Security and Liangnan Eco and Culture Tourism. In other words, the malaise is spreading once again from the real estate market to other sectors as the wealth effect causes consumers in China to cut back on their spending. And so this is not just a real estate collapse anymore going on over in China. Now, shifting gears to the United States, we actually had some pretty good inflationary data this week. We had, first of all, the producer price came in on Tuesday at 2.2% year over year. That was below the 2.3% that was expected and down rather significantly from the 2.7% reading that we had in June. So producer prices are still rising, but rising at a slightly slower rate than they were rising last month. And then we also got consumer price inflation on Wednesday. Again, it was lower than expected. The CPI print came in at 2.9% year over year. That's below the 3% that was expected and down from 3% in the prior month. Of note in this inflation report, more than 90% of the increase in the consumer price index was driven by the index for shelter. Home prices and rents, in particular, owner's equivalent rent, is the very flawed data point that makes up about a quarter of the CPI. More than 90% of the rise in inflation was driven by shelter. And that's important because shelter is considered to be a lagging indicator in CPI. In other words, we're already seeing home price declines in some markets and rental declines in some markets. Yet that shelter index is still showing a lot of sharp price increases. And a lot of people think that is going to fall dramatically in the months ahead, which means we've got some seriously lower inflation prints on the horizon. Also of note, we got a big negative number in used vehicles coming in at negative 10.9% year over year. Big drops in used vehicles. Even new vehicles went down in price by 1%, according to the index. Although notable price increases were seen in transportation services that saw 8.8% year over year growth. Most of that coming from increases in auto insurance, which has been rising dramatically, as I'm sure most of you are already aware. And then on Thursday, we got a rather shocking retail sales report. Retail sales in the month of July increased 1% month over month. That is a shockingly high number, well above the 0.3% that was expected and well above the negative 0.2% that we got last month. It had a lot of people actually questioning the accuracy of this data because according to this retail sales report, we saw things like increases in lawn and garden and home improvement spending in the retail sales numbers, even though Lowe's and Home Depot both recently reported sharp downturns in spending at their stores, with comparable sales down 4% and 5% at Home Depot and Lowe's respectively. So a lot of people are expecting this number to be revised sharply downward in the weeks ahead. But we also got some encouraging consumer news, depending how you look at it, from Walmart. Walmart reported earnings that beat expectations. Revenue rose 5% year over year. Also, more importantly, U.S. comparable store sales were up 4.2%. So more people are shopping at Walmart. General merchandise actually saw its first marginally higher print in 11 quarters. So it's not just grocery spending that's rising at Walmart. They actually, for the first time in almost 3 years, a slight, ever so slight uptick in general merchandise. Now, there's two ways you could look at this. Maybe the American consumer is doing just fine and everything's great and the recession is canceled, something we'll talk about later. Or maybe more and more people are being forced to regrettably shop at Walmart because they can't afford to shop anywhere else. You guys tell us what you think in the comments. Then on Thursday, we got initial jobless claims. They came in at 227,000. That's down from 234,000 in the prior week. So that was slightly below expectations. Initial jobless claims have been getting a lot more attention recently as unemployment becomes the much more important statistic versus inflation as in months prior. And although we are in a higher band these last couple of weeks, this was down sharply from that 250,000 number that we got 2 weeks ago. Also, continuing claims ticked down ever so slightly to 1.86 million. That's down from 1.87 million a week earlier, although continuing claims are still way up from some prior months, showing that maybe the rate of people losing their jobs might be slowing a little bit these last few weeks, but people are still having a harder time finding a job once they do lose their job. And that's not surprising considering stories like this. Cisco cuts thousands of jobs, 7% of their workforce as they shift their focus to AI and cybersecurity. Cisco is cutting another 6,000 jobs. This is on top of the 4,000 jobs that Cisco cut just back in February. So the big layoffs in big tech are continuing. And then another particularly doomy story we got this week on Thursday, 2.9 billion people may have had their Social Security numbers and other financial data compromised. Guys, pretty much every man, woman, child in America had their Social Security number stolen again. Yep. And also included in this data was past and current addresses, full names, massive data leak here. The cyber war continues. And last but not least, we got this wonderful economic plan. Communism for several hours yesterday was the number one trending topic on Twitter because presidential candidate Kamala Harris unveiled her economic plan, which was essentially full-blown communism here in America. She wants to give every first-time home buyer $25,000 to help them buy a home because adding even more money chasing housing is supposed to be how we make homes more affordable. Anybody want to explain that to me? I'm all ears. The plan also included targeted measures aimed at taking on price gouging. In other words, price controls at grocery stores, besides a case study in an abject failure of our education system. This just goes to show you how far we've fallen, guys. We're talking about price controls at supermarkets here because that works so well in all these fine places like, I don't know, Cuba and Venezuela. And does anybody remember Russian President Boris Yeltsin actually crying when he toured an American supermarket shortly after the collapse of the Soviet Union because he couldn't believe how much food was available here in America because they had price controls in the Soviet Union? And as is the case everywhere else, when you implement price controls, you end up with severe shortages of pretty much everything. Although try explaining that to our press, who was strangely silent on this topic. Imagine if this was a mean tweet about somebody, how much attention it would have got. But economic illiteracy going mainstream in America, surprisingly, very little news from our financial press about this one yesterday. And that concludes This Week in Doom. But wait, there's more. We have a special, extra doomy segment this week that we have to bring. I've got my buddy Travis is ready to queue up this video here, guys. What a fantastic bit of mainstream doom we got this week. Travis, let it rip, buddy.
All right, let's talk about the American dream for a moment. The U.S. housing market, it remains incredibly perplexing, right? Many assume that this recent decline in mortgage rates would spark buyers. A lot of folks had to be sitting on the fence, right? Instead, what it sparked was an 118% surge in refinancing applications. And then there was this morning, we got the housing market index. That tumbled big time. The reading of 39, the consensus was 42. I want to bring in a special guest. I've been reading her work for a couple of years now, so it's a pleasure to bring in Haringa, CEO, founder at Melody Wright. Melody, what are buyers waiting for? I mean, I know obviously some people assume the rates are going to get lower, but there have to be people who've been champing at the bit, wanting to own a house, and this first opportunity, they didn't take the bait.
Right. They are waiting for lower prices, Charles. They cannot afford these prices, and they're a little mad, you know, with what's going on with the bidding wars and things like that. And so until prices come down, I do not believe we'll see the demand.
I read an article that in Canada, prices are going to take a decade to normalize because they got so inflated. Now, we weren't as inflated as Canada, but I mean, people are waiting on prices. They could be waiting. It depends on unless you're one of these really overbuilt markets, you might be waiting a long time.
You could be, but I definitely think that we're going to see some of those price declines this spring. And I think in 25, we're going to see a significant price drop, in my opinion.
And next year?
Yeah, 2025.
So hang in there.
Hang in there. I'm not saying that'll be the bottom, but I do think that's when all of the headwinds facing housing are going to arrive and will impact pricing. So
then recently you put out a post, JP Morgan, their HELOC portfolio with the delinquencies inside of it. And these are prime, higher end folks. What is the, more often than not, we talk about the housing market as a reflection of the economy, but is it also telling us something else though? Is there an issue that the economy beyond pricing with this housing market?
Well, I think what this is telling us is that perhaps all of that credit quality gospel singing that has gone on since Dodd-Frank might not be warranted, and that, as always, we got a little over our skis. At JP Morgan, that is supposed to be a pristine book, and for it to be over 6% delinquency, that's a lot. That's a lot.
That's a red flag, though.
It's absolutely a red flag.
Is it just a red flag, though, for housing, or could it be a red flag for the economy?
It's for both, in my opinion.
Yeah.
Mm-hmm.
A lot of people on TikTok videos, young folks are always upset that older people are able to buy a house like with no money down, $5,000, and now it's worth $3 million. And to your point, they're so expensive. How much of it is myth making, though? Is it really that much harder for millennials than it was for past generations right now?
I absolutely believe so. I mean, this is, some argue, the most unaffordable market we've ever had. Yeah, and I think with, inflation, property taxes, insurance, and the cost of home ownership, they are just completely priced out of the market.
So you should be excited because VP Harris tomorrow is going to talk about the government coming to the rescue. Should that help everything?
Has it helped it so far?
And will it help? The government's going to come in and build a lot of houses. They're going to come in and take action so that everyone can afford a house.
Yeah, my contention is we have the inventory. We don't have affordable inventory, but a lot of the inventory was scooped up by institutional investors, short-term rental, mom and pop investors. And so I think as sort of the economy starts to deteriorate, you're going to see that inventory continue to come to market. So I think a lot of people are going to be very surprised about the increases in inventory we'll see in the spring.
But you don't want the government involved, do you?
I do not, no.
Okay. You can come back. Good stuff, Melody. Appreciate it. Talk to you again real soon.
I love it. Congratulations, Melody, going mainstream with the doom. By the way, we didn't tell Melody we were going to do that. She was caught off guard by that. Melody, congratulations on your appearance on Fox Business with Charles Payne. Look, I am a big critic of the mainstream press and the mainstream financial press, but let me just say, Mr. Payne, Sir Charles, is one of the rare bright lights in that very gray cloud. In particular, during the GameStop fiasco, and when they took away the buy button, Charles Payne was the only one who even entertained the concept of maybe the apes were onto something. Maybe big money was offsides. And he was the only one in the financial press that I'm aware of who portrayed the apes as anything other than a bunch of idiots who are too stupid to be in control of their own money, and the government needs to step in and rig markets for their own benefit. So I really like Charles Payne. I thought your segment was excellent, and congratulations again. Job well done.
Thank you, guys. Thank you so much. I'm thoroughly embarrassed now.
Really? I only had one. I had a question, Melody. I had a question. And this is why I had to postpone today and I got bad sleep. How close were you to not coming back to DNN?
Didn't even cross my mind.
Really? Because I was I honestly, I was worried the whole time. And honestly, I asked her, guys, for the viewers, the first question I had for Melody was, were you nervous? Because I don't know if I could have got off the plane when it landed. Were you nervous at all going on to like a Main Street platform like that?
Oh, you're not going to say what I said. Okay. A yes and no, I would say. Just more, they made me very comfortable. They were very nice. And I think, I really just wanted to share some reality. And so I just focused on that. And so I wasn't too nervous, Travis.
Melody, if I could ask you real quick a question, something that jumped out at me in that segment that you did, the 6% delinquency among, correct me if I'm wrong, it was HELOCs at JPM, right?
Chase.
They were talking about?
Mm-hmm. Yes.
Now, you mentioned it was supposed to be a pristine book.
Yes.
Could you elaborate a little bit on that and why you found that 6% delinquency for HELOCs at JPM so alarming?
It's book. Well, so sorry, you're going to get me riled up a little bit, Jack, but it's, it's over. It's part of that credit quality gospel singing everybody's been doing, that nobody's doing interest only. Nobody's doing these non-traditional products. Well, that's exactly what that balance is, over 90 billion of those HELOCs. Some of them are interest only. And so, it just really sort of infuriates me how much everybody has been able to gaslight the public as saying that this non-traditional lending has not been happening, and also that it's not of concern. And, it's very much part of the gaslighting around this is nothing like 2008. So. Yeah,
and 6% is pretty incredibly high.
Very high.
And once again, I hate to keep doing this. I always bring up buy now, pay later. But here we've got JP Morgan's HELOC book is at 6% delinquency. We're seeing mortgage delinquencies rise. Credit card delinquencies are rising. And yet these buy now, pay later executives are still insisting that delinquencies on these buy now, pay later loans are only in the mid 2% range, when every other category is rising dramatically. And conveniently, none of the data on buy now, pay later ever gets reported. So I got to call that out again. I don't think the mainstream press, I don't think people are looking close enough at buy now, pay later and what's really going on there. I think they're outright lying about delinquencies.
Yeah. And so here's what they could be doing, right? And some of the big banks do this, that once they go into non-accrual status, they kind of say it's not in their portfolio anymore. So they move it into that non-accrual and they write it off. So they could be saying, like, and non-accrual can often happen between 90 to 120 days of delinquency. In my day, it used to happen at 60 days. So they could be doing a more aggressive thing that once that gets to 60 days, they just completely write it off the balance sheet. We don't have access to their financials. And then they can claim that delinquency is lower. That's what I think is happening.
So they're they're securitizing this buy now, pay later debt, right? We've talked about that on this show. So you're saying once they securitize it, they're no longer on the hook for reportability on that data. Now it's with the servicer or whoever's managing that. And of course, they could, if it has to be 120 days before they report it as delinquent or whatever they do, well, if they securitize it within those 120 days, then they never get around to actually telling the truth about who's paying them back or not.
It's more like it's just an accounting trick. Like essentially you say so the banks all have to do this. If something is over a certain amount of delinquency, you have to write it off your balance sheet and you have to take that loss. And so because we don't have access to their financials, we don't know if they're taking those losses and hiding them when those loans go into non-accrual. And they could do it as early. We used to do non-accrual at 60 days. That's been changed in the marketplace. I went and looked at Chase's books, but if they're doing an aggressive write-off process, then that would make their delinquency look a lot lower than it actually is. And it'd be a legitimate accounting maneuver, but they'd have to hide the losses. I hope that makes sense.
It does. It's very deceptive. It's very creative accounting.
Exactly.
But maybe doesn't cross that threshold into illegality or outright fraud. So they have their deniability, never mind how much damage they do to people by not painting an accurate picture of how risky the investment is. So excellent job, Melody. Again, congratulations on going mainstream. And don't forget about we little guys when you're all big and famous, and when you're in your trailer telling your booking agent, your publicist, and making all kinds of demands now that you're a superstar. No, I'm just kidding. She doesn't do that, guys. Melody's awesome. But job well done.
I'll be out in the garden, guys. Yeah. I'll be out in the garden.
All right, guys.
All right. I'm going to move on. But real quick, Melody, on a real note, super proud of you. And thank you for being a part of our lives, dude.
Thank you.
Good job, Melody. I'll move on before I get
without you guys.
roasted.
Couldn't have done it without you guys.
Oh, yes, you could have. Oh,
No.
yeah. You couldn't have done it without Jack. I'm sure Charles said, we're going to have you on. But
Ease up, everyone. Ease up, everyone, okay? Let's not get too mushy for everyone, all right? You guys don't want to be like me, getting roasted. Real quick, shout out to K-Pal. I love you on X. I almost said Twitter. This guy's absolutely hilarious. If you guys don't know, you should know. Go to X and check him out. He's absolutely hilarious. He's like Johnny Fly 2.0. And his dog loves him. Johnny's dog doesn't love him. Logan loves me more. And I'm talking about Johnny's dog, not the Bloomberg guy. But anyways, guys, I'm going to get started right now. I want to start by talking about bifurcation, since that's the new cool kid word when it comes to the housing market. So I'm going to just throw myself up here real quick, and I'm going to try a little something different. As far as bifurcated, what I want everyone to understand is as someone that's tracking the data, we get that housing markets are different. And that's why you guys see a lot of, first of all, there's many reasons why you see so much division around social media about the housing market and about the economy. I mean, people are always arguing and fighting back and forth. And the main reason that is to keep us divided and to keep us confused about what's really going on. But there's also truth to it, because as you guys can see, when we're just looking at active inventory, I want to show you 4 different states that are in much different shape compared to each other, starting with Texas. Texas has more active inventory than since 2016, you guys. Texas has an 8-year high of inventory. Where's the buyers? I'm sorry. Where's the buyers at, guys? Okay, where's the buyers at? But that's Texas. Texas is its own thing. We have a whole bunch of new construction in Texas. But take a look at this, guys, all right? So all I'm saying is like, we got to be, and I know maybe I'm preaching to myself, a little less polarizing, because take a look at New York. New York does have low inventory still. It doesn't mean there's a whole bunch of people buying. It doesn't mean that it's affordable again. It just means that New York is going to take more time to get back to balance. All right, that's it. But it is different. So New York is down from pre-pandemic, but again, it's bifurcated. Again, remember the special word today. Florida, again, above pre-pandemic, not as much as Texas, but Florida has a massive surge. This is skyrocketing trajectory of inventory. And it's not even the technical where all the public understands we're in recession, people are losing jobs. So if we do, and you guys should know this, if we have our event, when that collapse happens, expect these types of trends to continue, right? Expect all of this to continue, because the cat's really not out of the bag for all of mainstream households, which is just so surprising to me. Anyways, but take a look, just, proof is in the pudding here, guys. Look at New Jersey. New Jersey's down as well. So the housing market is divided. We want to make that, a huge point because it's true. Now, what I'm going to do, guys, is we're going to go over Redfin's housing market report. So I'm going to go into that, and then I'm going to show you where we're at as far as demand and interest rates. Because the reality is, and I'll get to this data point, is interest rates are lower, and now we have the demand data updated. Demand is lower than when rates were at 7.22%. So rates peaked this year at 7.22% in April. Again, guys, April of this year, interest rates for mortgages peaked in April. Demand is lower. Guys, get it? Demand is lower than where rates were peaked at 7.22%. So that's very, very telling. Now, I'm really starting not to like this Redfin, this whole Redfin report, Melody. I mean, this is absolutely, I'm going to show you guys again that they're lying again. Okay, so I'm going to show you again, once again, Redfin is not telling us the truth or is being transparent about the data. But the name of this article is "The Typical U.S. Housing Payment Has Fallen to the Lowest Level in 6 Months." However, and this is the important thing for everyone to understand, that has led to more buyer interest, but, and there's a huge but right there, not more sales. So the whole narrative that America was being pushed for the last 2 years on, you better hurry up and buy, because the moment that interest rates go down, everyone's going to get off the sidelines and rush in. So you got to buy a house right now. You guys remember that? Everyone was saying that. The National Association of Realtors, our local realtors, you got to buy now. People would flood back in, but we aren't saying that. And I'm going to show you guys that data. Now, the median U.S. housing payment has dropped to nearly $250 below its spring peak. Wow. Isn't that great, Jack? So roughly, on average, house payments, and we're not counting taxes and insurance, mind you. Okay, we're not counting tax and insurance, which has skyrocketed. It's down $250, Jack. Let's not talk about the $1,000 higher it is, though, from 3 years ago. But it is down $250, so that is some good news. And again, the article indicates, despite declining costs and improved inventory, pending home sales have not yet improved. You guys, this is like summer home buying season right now. Okay, now let's listen to the over-optimistic agent. I've circled that right here. And then we're going to stop listening and reading what Redfin has to say. So here's over-optimism this week. I love this. This is an agent. This is a Redfin realtor. "I was hoping more buyers would emerge when mortgage rates started declining." At least that's what you were telling everyone, right, agent? That's what you were telling your clients, right? But that's not what happened, is it? Are you going to refund those people their money? You're going to refund them their money? You're going to refinance them out with your money? I don't think so. And that's why I'm always get so frustrated at the bulls, because when the bulls lead people into making decisions, they're stuck. We're saying save your money and hold on. The bulls are saying spend your money right now or else. Okay. And while house hunting has picked up a bit, it's the energy drink. I'm sorry, guys. The increase isn't all that significant. Okay, budgets are typically, and I'm highlighting this here, agents need to understand this, the most important factor for buyers, and homes are still really expensive, for a lot of people. Like, why is this agent surprised, Melody, Jack? Aren't we supposed to trust realtors? Is the agent really surprised that houses are overvalued and people can't afford houses? I mean, demand is in, back in the 70s and 80s, and yet our population is bigger? Total failure here, guys. Total complete failure. I don't want to be mean to anyone. And I don't want to pick on realtors. I'm just very frustrated. I've been an agent for a long time, so that's just been building up for me, man. You're just watching these games. Now I want to go into the actual data. Sorry for the ranting. Here's the data right here, you guys. We're sitting at an average daily interest rate, as far as when this article was completed, at 6.49%. Let me get that a little bit bigger for you guys. Okay, now year-over-year comparison on the daily, okay, we're right here. So again, when we're looking at the year-over-year for daily, interest rates are much lower. When we're looking at the year-over-year for weekly, much lower, 6.47 right now. This time last year, 6.96. We have the data now, so we don't have to guess, is there going to be a rush of buyers? We have the data, and the answer so far, guys, just so far, that it's a big ol' no. There is no buyers on the sidelines that can afford these houses, because they pulled forward a lot of that demand with your nonsense, prices only go up, blah, 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 blah. And they play that bifurcation. So even though rates are down, again, which would increase purchasing power. Look at this. All measures of demand are down. Mortgage purchase applications are down. Redfin home buying demand index is down 10% year over year. Even searches online are down 3%, although that is going up on a weekly basis. So, it is what it is. And I want to show you guys this. Okay. So they're saying that median sales price this week is 389,250. Do you see that right there, Melody? Jack, can you see that? Okay. Okay. So it says 389,250, right? That's this week's. And it's also saying up slightly from a week earlier. Do you see that? You guys can see this, okay? Because I really want to make this point. I really want you guys to understand how they're lying to us, okay? So far we know that this is up. This week's median, according to them, is up slightly from last week, okay? But let's look at last week's. Okay, here it is right here. All right. You guys see that? Last week's 4-week rolling ending August 4th was 389,750. Do you see that? Do you know what that means? Let me show you again. Okay, whoops, I messed that up. I hate when I do that. Okay, so this week's median is 389,250. They're saying it's up slightly. Okay. However, last week's median was higher than this week's median. Last week's median was higher than this week's median. This week's median 389,250. Last week's 389,750. They revised it. How Jack? I mean, how are we supposed to trust these data providers, brother?
Downward revisions to prior data being unspoken, right? Where have we seen this before? The jobs numbers, we see this all the time. We're probably going to see this with those amazing retail sales numbers that just came out this week. The unspoken or unaddressed elephant in the room of downward revisions to prior data sets. I mean, it's becoming so common. It's a joke right now. And, this data is too important. Too much money hinges on these, too many decisions are made based on these data points, and they're becoming less and less accurate. And I think it's a problem.
What about the kids that are leaning on this data to make decisions? I mean, look at the confidence that some people are quoting this data. I mean, they're so confident, like Redfin says this, we can trust Redfin. What about that, Melody? What about that?
Yeah. Anybody that trusts this Redfin data, again, why are you looking at the people who are going to make money from either selling your data that they get when you go visit their website, or trying to sell you on making a purchase? And so, again, we don't have any independence in data providers in many ways. And we'll talk about this in the China story as well. The US, in my opinion, is very similar to China when it comes to data. Now, we cannot trust anything that's coming out. And in fact, they've kind of, they're looking for the inventory data. Fred uses realtor.com. And so we can see that all the data we're getting, and none of it is independent, is coming from these vested interests.
Okay.
Not acceptable. Yeah.
And real quick, big shout out to my boy who came back. Okay, so I was talking to my boy right here. I was looking for you, Chris. I love you, brother. Thank you so much for coming back. You guys remember last week. I like this kid, all right? I like you, Chris. And I'm going to show him the trajectory. So I want you to know, Chris, because I appreciate you, I have a special data set for you, because I thought you were going to say that. And it's actually about demand from a different data source as well. So we don't have to just look at Redfin that's showing demand is down. We have other data sources. All right, let's keep going. All right, now this week's winners and losers, all right? If you trust this data, I don't trust this data. Anyways, guys, so we have 1, 2, 3, 4, 5 top biggest metro areas with the biggest year-over-year increases, okay, bifurcated, right? And then even then, you guys got to go hyper-local into subdivision. But number one, as far as year-over-year 4-week rolling median, there's many different data providers that calculate median, remember, but Philadelphia is up double digits year-over-year at 12.5. Detroit, really shocking, 12.4. Not surprised about Anaheim, 11.2. And by the way, Anaheim has the most $1 million houses. Is that crazy? Like, have you been to Anaheim? I have. All right, so Anaheim's up 11.2. Newark is up 10.3, and New Brunswick 10.1.
You got to get your New Jersey with accent going. It's Newark or Newark.
I'm never gonna say it right.
You're from North Jersey. It's Newark.
I butcher it. I'm so sorry, man. I'm so sorry. I suck at it. Okay, but the biggest losers, guys, number one, bid should be no surprise to most people. Austin's down 0.3%. Austin's taking a beating. I think we're seeing the surge and decline for a few reasons that these other areas aren't facing yet, which is People moving out, a lack of migration supporting the values. We see the job market taking a hit with Tesla, and Austin was a massive boom town during the pandemic, meaning the values shot up very unrealistically, very quickly. And now you're seeing that deflation happen in Austin. What's also interesting, though, is Tampa's on the list as well. So we have a Florida metro on the year-over-year decline list at 1.3% down. Tampa, Florida. And then obviously another Texas metro, San Antonio. Again, I think that Texas is all over this. And I think Florida will eventually be all over this because of our new construction inventory. These states like Texas and Florida, we constantly have new inventory coming to the market that a lot of these other places like New Jersey don't have because of new construction. And put in perspective, guys, I have as many, if not more, actually, I have more new homes for sale in my market than existing. I have more than existing. So it is a lot different here in Texas, at least in that aspect with inventory from new homes. Now here's where we're at with median. And look at this, guys. People are like, oh, look at, they revised it. And now look at the trajectory. The trajectory shows it's going up or going sideways. And that's my gripe. People are like, it's just a little revision. It doesn't matter. Any revision that you're lying to people to push your narrative, you can't trust you immediately. Unless you prove yourself or explain yourself, but we're not getting any explanations. I constantly tell viewers they continue to manipulate trajectory on these graphs, okay? But regardless, from peak right here, guys, we have been heading downward 5 weeks in a row, even though they revised this. So they did revise it, but when we take into account, why can't I draw a straight line? When they take into account that they did revise last week, we have 5 weeks in a row of 4-week rolling median sales price decline, totaling about roughly, this is not to the penny, $6,700. I also want to bring your attention here. Okay, that's what we started this year as far as the 4-week rolling median for Redfin. We start at 361,225. So what I'm expecting is that we will end, and I'm saying this out loud, right? We don't have to hide this, but I'm expecting nominal price decline this year, which means I believe we'll end the year under 361,225. But remember, guys, in order for us to even have year-over-year price decline, we would have to go under that orange line right there. Okay. But also remember one more thing. Okay. This red line, that red line is 2022. Okay. That red line before they revised it went all the way, right about there. Okay. So that red line went all the way up there. They revised it downward. So in 2022, it was actually almost like $2 off of 400,000, which means, let me change the color here real quick. This was the trajectory of 2022, just so people are not fooled by this. Okay. We peaked right about there and it went essentially like this. So in other words, don't think that prices can't go down very quickly. Flash crash. And really, if you look at the differences of 2022 and right now, it's like the consumer awareness. There's a bit more panic. Regardless, you guys, median asking price is up 5.9% year over year at $398,000. Here's home buying housing payments. Here's the biggest impact that the housing market has been having on people, the unaffordability. The unaffordability is incredibly powerful. So even though, look at the trajectory, okay, so housing payments have been going down and they want to celebrate. It's gone down $250. But what I'm saying is remember this. Okay, look at this line. Yeah, it's cool. I'm glad it went down $250. I'm not saying that's not good. It's good. But we got a lot more room to go, right? The housing market is so unaffordable, even with prices going down a little bit. Even though Austin's down almost 20%, just depending on when you're looking at it, it's still so unaffordable. Even with that decline, that's how toxic an unaffordable housing market is. But you guys, when we were 2021, we were around $1,600. Now we're at almost $2,600. It's $1,000 more a month. Now, what's going to suck, Melody and Jack? Next year, when they start coming out with these charts, guess what's going to disappear? 2021. And so people will forget where we've come from because that will disappear. People forget easy, but we won't let them forget easy. We won't let them forget easy. Let me keep going here, guys. Okay, so pending sales is at a 4-year low for this time of year. All right, so for this time of year, 4-year low. All right, and that's pending sales. New listings. Now, new listings, we talked about this last week. Remember, Melody? I was like, maybe we saw it. Maybe it's a trend. Maybe it's seasonality. So still no trend because the trajectory of reverse for new home listings. So we still don't have enough information to see what's going on there. But I recently did a video from Zillow that it was basically saying 80% of those new listings are people that are selling because of some type of life event. So something has happened, economic, size of family, like death or something has happened. 80% of those appear to be, as you would say, motivated, right? But we didn't see that continue uptick like I was hoping that we were going to see. So we'll keep an eye on that. Here's active listings. Oh yeah, go ahead.
Travis, if I can say something, so I think, I've definitely, I track inventory very closely and definitely am seeing it slow. That's what's happening. But we need to be thinking about seasonality. For instance, in Florida, their season starts in October. And so I think typically this is when inventory is going to slow down. I think, though, what would be more important to look at is how is it slowing as quickly as it has in years prior and things like that. And because, Florida will wake back up in a couple of months here. And I think this trend is going to start to reverse again.
Okay. Yeah. Like it did last year, right?
Yeah, exactly.
Jack?
Trav, one thing this chart tells me also is that with the new listings is that the forced selling hasn't started yet. That the higher unemployment rate that we've started to see, unemployment's risen now from a low of about 3.3, 3.4. Now we're at 4.3%, and it's starting to rise faster. It still hasn't translated over to people being forced to sell their homes yet. We haven't broken that seasonality. So once that starts, and it takes a while because savings gets worn down and people don't go into foreclosure right away. Maybe there's severance pay, but as people lose their jobs, I think we'd see this chart break seasonality and start heading sharply higher once the unemployment starts to inform new listings.
Yes, I agree with you, but I also want to caution people that may be already happening in those numbers. If we don't actually know why these people are selling, like I said, Zillow potentially said 80% of those are already for selling. So also, and I bring that up, Jack, because it also demonstrates to us, and I think you would agree, Melody, that there's still a freaking millions of people on the sidelines that would sell their house right now if they could afford to, known as the golden handcuff effect. I'm thinking there's millions, Melody. Do you agree with that?
Yeah, I mean, there are a lot, and honestly, though, it's like you're saying, they can't. There's nowhere to go. They can't afford it. I mean, what they're going to do? They were taught during the GFC. They'll stay in those homes. They'll just go default and write it out. So I think, but I do think that we are seeing motivated selling versus distressed selling, meaning. But that could include unemployment. It's just not, I think what you're trying to say, Jack, is that, it's going to accelerate quite significantly as the lag effect from this rise in unemployment.
Yeah, I think we'll see this, this rainbow shape will just all of a sudden bank upward and shoot higher once the unemployment really starts to cascade into the home market.
We're waiting for that, buddy.
Yeah, I think that's coming. I can't tell you when it's going to come, but at some point we're going to see a pretty stunning deviation from these prior years.
And that's a good data set to watch. I mean, I wish we had the intimate knowledge of like, why are you guys selling? But it's still an interesting data set because it could potentially show us some signs of that motivated for selling, and then the golden handcuff, seasonality, defaults. But active listings, guys, the good thing is this is according to Redfin. Active listings, again, over 1 million. We've been over 1 million since about right here. So we're doing good. We're trending a little bit downward. I don't really want to see inventory for obvious reasons be under 1 million, but we are over slightly by 5,700. Good news on the supply front. Now remember, guys, supply is measuring inventory and demand. And right now we're sitting at 3.6 months. Obviously that can change drastically, probably in 1 month. This could probably change 2, 3, like to 4.7 or even 2.7 in 1 month, depending on what happens next. But I think it's interesting when we look back in time and we look at 2017 and we look at 2019, it was for the whole year, it was 3.7 months of inventory. So we are matching, if we were to freeze time right now, right? So I get it. Freeze time. I got you, Melly. We're to freeze time right now. We have almost the same amount of supply, measure of inventory and demand, as we did 2017, 2019. Melody?
I just want to mention Redfin particularly. So guys, when I think everybody knows I track over 80 cities each week looking at a whole bunch of different metrics. And I use Redfin for a lot of the sales data and things like that. And I can tell you they track very closely to existing home sales, which means they do not have new home inventory, or they have a very small percentage. And Travis, as you and I have shown over and over again, there might be one listing for a subdivision of 500 homes, right, on Redfin. And so I just want everyone to remember that these numbers have very little new home inventory in them.
100%. Yeah, we're looking at we're supposed to be looking at existing. So this is supposed to be existing. They did sprinkle in new home data, which is that's so shady in my eyes, Melody. But this is supposed to be existing. Now, as far as pending sales under contract within 2 weeks, we're at 37.1, still high-ish, I guess. 4-year low for this time of year, regardless. Again, another sign of demand. Home sold 35 days, or home sold in a median of 35 days. So 35 days DOM. That's, again, my eyes, that's one of the leading indicators. So look in your local housing markets and see if the homes are just sitting there. Now, as far as homes sold under final list price, like, so there's a price cut, right? 4-year low as well. Okay, meaning that homes are selling for under list price. So for your low, remember, guys, what I'm saying, though, for this time of year. So this is actually comparing seasonality. So it's a 4-year low for seasonality. You guys understand what I mean? So 4-year low there. Now, it's a big deal. Okay, this is a big deal. Listings with price cuts. Now, I know a lot of people don't like to look at listing data. I'm telling people, if you're not looking at listing data, you're robbing yourself at really understanding what's going on in the market, because house prices start with the listing. And so you have to use the listing price to understand if it's above market, if it's below market, and then there's trends with listing price. But whatever, okay, we're at near an all-time record high for price drops. Funny that Redfin's not talking about that. They can't even add math. Apparently, Redfin can't even add math. Why aren't they talking about the all-time record high price cuts, demonstrating sellers are starting to understand that they can't get those asking prices? So I would like to ask you, Melody and Jack, if I could just start with you, Melody, because I know you're all over this. Why do you think that we have an all-time high, near all-time high, according to Redfin, price drops?
I mean, nobody can afford these prices, Travis. This is absolute insanity. You just have to look at, wages, what people are making, what the median income is versus the median price. I mean, understandably, we've thrown out ability to repay and everybody just looks at the payment. But in reality, people they are now so debt burdened that, the bottom 80% cannot afford these prices.
And this is my buddy right here, Charles. Charles, I love you. I've had him on my channel. I really appreciate him. He's actually in the Real Estate Mindset Discord. He helps a lot of people, a lot of first-time home buyers. He's got a ton of experience, so I respect this man. I'm bringing this comment up because I also had a preconceived notion that a balanced market was 6 months. But the crazy thing, Charles, when I go back and I look at how many years actually had 6 months, one of the only times we had 6 months was during the freaking recession, during the GFC and the recovery of the housing market. Prior to that, we don't have 6 months. So I'm going to be honest, brother, I got pulled into that narrative. Yeah, so what I'm saying specifically, Charles, is we do not need 6 months for a balanced market.
If you go to NAR's website, Travis, and where they talk about that 6 months, they say that's for an appreciated home price environment, meaning that 6 months would kind of be the place that would sort of generate that home price. So my point being that this is just a made up number. They provide no historical analysis. It's just one of those things people repeat over and over and over again.
Yeah, and I'm going to get to the demand. So I hope Chris is still here, but I'm going to get to the demand after this. Jack, did you want to add anything there?
Yeah, I would just add, even though we're at an all-time high, I mean, look at the prior 3 years. This chart peaks October, November. Makes sense, right? People's homes didn't sell in the summertime. The home buying season's behind them, so they try to cut their prices in the fall before they pull the listing. And, well, that means we're going higher here. We got 2-3 months of additional price cuts on the horizon, just looking at when these charts peaked out in the past.
Yeah, about 2 months, about 2-ish months. That's what I've been saying with those leading indicators. I'm like, we're about 2 months ahead. We'll see, though. We got more to go. We got elections. We got printing still going on. So we'll figure this out together. Let's see if there's anything else I want to go over with you guys. Average home sold for 99.3% of final listing price. So not like, overall, according to this data, not massively under market, right? But still 4-year low for that time of year. And here's another gauge of demand, all right? But I want to give you guys something else as far as demand. And if Chris is on, okay, good, Chris is on. Chris, I got this for you, brother, okay? Now, take a look at this, all right? What you're looking at here, and this is for everyone, but I'm talking to Chris because I appreciated him. Now look at this, okay? Here's the composite index. This measures demand and rates. And okay, let me do, this is the 1 year, okay? The demand is like this, the composite index in blue, guys. You kind of see that, right? So to Chris's point, look, it looks like that composite's going up. Do you see that? It is going up. You see that composite going up, guys? So look at rates go down. See that? And the composite goes up. So I understand why he's saying that. But what I'm saying is you got to look under the hood. You got to look under the math, because if you're only looking at this and you're not looking at anything else, it's possible that you get stuck in someone's narrative. And so when we break this down, Chris, between purchases and refinances, we start to get the truth. And take a look at this. So when we just break out refinances, look, you guys see that massive skyrocketing spike right there? Do you see that? That blue? You see that blue? Just absolutely berserker. Do you see that? Can you guys see that okay? Okay, what you're seeing, Chris, is thank you, brother, for noticing that. What you're seeing, Chris, is you're seeing refinances absolutely skyrocket, and that's affecting the overall composite index. Okay, so and then, by the way, you guys, that's not a healthy sign of the economy. Refinancing blowing up like that and people refinancing to a 6.5 does not demonstrate people are okay. Okay, but look I went further. This is the actual purchase index. So when we cut out everything and we're only looking at the purchase index, this is what I want to show you, Chris. So we peaked, okay? Interest rates peaked at 7.22%. This was in April. Look at the purchase index. The purchase index was 141.7. So when rates were at the peak this year at 7.22, demand was, and according to this composite, 141.7. Okay, so rates went down all the way to 6.49. And look at the composite index, it's lower. What this means is demand, according to this composite index, I know there's multiple data sets, but according to this composite index, demand is now lower than what it was where interest rates were at the peak. Okay, again, let me show you again. Here's peak interest rates. You see that 7.22%. That is the peak for this year. Purchase index, we're taking out now refinances. 141.7. Okay, so fast forward all the way to right here. The purchase index goes down to 137.7. Meanwhile, rates go down 73 basis points. And that's the point I wanted to make right there. Now, if we want to look at, should we look at CME Fed Watch? Do we want to waste our time here, Jack? What do you think? Yeah, okay. So here's CME Fed Watch. If you guys are going to, wondering what's going on with interest rates, the market doesn't know. The market doesn't know. Now, just in 1 week, the market's now saying 75% of the market is now saying there's only going to be a quarter rate cut in September. Do you remember how it was like 80% of the market was like there's going to be 2 rate cuts? Now, when we go out to December, the market again starting to calm down, which is they're just all over the place. But now the market is saying they're going to have 3 to 4 rate cuts. So 75 basis points to 100 basis points in rate cuts. Really, they're saying in between that. So this first one represents 75 basis points, which would be potentially 3 rate cuts of 25 bips. And this one's 100 basis points, which could be, 250 basis point rate cuts. The frequency is different. It's just saying by the end of the year, that's where we're going to end. So anyways, you guys, that's what I got for you today as far as my housing market update. Hope you enjoyed it. It was a little bit long. Any questions for me?
I just got a comment, Travis, that, we've seen rates come down pretty sharply these last, let's say, few months. And it's obvious that it is not helping home buyers, right? So the housing market is not really benefiting from these lower rates. It's not translating into more sales. I think that's pretty clear. What I think the risk is here is what we are seeing these lower rates translate into is a surge of refis. And I think that's probably benefiting the consumer economy more so than the home market, because why would anybody refi at these rates? I think it's people are refinancing to pay off or to consolidate credit card debt. And unfortunately, studies show that when you use your home as an ATM to pay off credit card debt, you are prone to run up those credit cards again, because it creates the illusion of financial security. People feel better off financially, and they go on shopping sprees, and they end up right back where they started, but now they've also leveraged their home. So be very careful if you're one of the ones falling into this trap, right? And you're putting the cost of inflation on the credit cards, and now you're leveraging your home to try to reset that. Well, now you're up to your eyeballs in home debt. You've got that bigger monthly payment. If you don't adapt your lifestyle, you're going to end up right back in this mess. So, maybe this partially explains a little bit of the surge in consumer spending that we're seeing in some of these good retail numbers. Maybe the refis is translating into more consumer behavior, which just means more long-term pain deferred.
It's all fraud, man. I mean, I don't know what to say here. I mean, everyone's paying attention. I want you to talk, Melody, but everyone's paying attention to the stock market as if they're investors in the stock market. Why does what the top 1%? Why do I got to make my decisions as a consumer, normal consumer, based on what the top 1% is doing? That's just doesn't make sense to me. What were you going to say, Melody?
No, I was just going to ask my question, Travis. So I know we kind of talked previously, but this sort of bounces off one of Jack's points. When do you think? Because we do know that I've studied 25 years of history. We know that even in 2008, 9, 10, 11, prices increased during this season. So, but we know we're rounding that corner and they're going down, and that's just a seasonal trend. When do you think that we might sort of accelerate that?
When the public will, when we see in headlines unemployment, when we see in the headlines recession, because that's going to hit mainstream. And unfortunately, the way things work, Melody, is like there was a huge interest 2 weeks ago on Monday because the stock market was doing bad, right? Even though half the people aren't even in the stock market. And so when the stock market's flashing reds, people are like, maybe I should start asking questions on what's going on. Maybe we should be cautious. But as the weeks progress, the last 2 weeks, the market has rebounded. And because it's rebounded, people are like, all right, let me just stay in my bubble. I don't want to go out of this bubble. It's painful. I don't like what's going on, Melody. I think that we're looking at the wrong indicators. I think that, again, people have to wake up. I think it accelerates when people are aware to stop buying. And then unfortunately, the other people that will not stop buying, their purchasing power, unfortunately, has to be taken from them. And that sucks because honestly, that's not fair. People should be way more, people should have 2, 3 times more their wealth than they have now. People should be thriving right now, but because of the fraud, corruption, greed, and specifically the Federal Reserve, we're robbed, man. We're robbed of that life. That life, again, we work hard. You work hard, Melody. You're on Fox News, man. Jack, you're working hard. I mean, I'm working hard. I'm barely hanging on. That's not fair, Jack. That's not fair. My children are bankrupt. My children have to get out of debt before they could be successful in life. I don't like what's going on. I don't know if that answered the question.
Not at all, but thank you.
Okay, sorry.
Okay.
All right. All right, let me throw. And life's not fair. Okay, so JJ Watt, appreciate you, man. I hope your injury, I hope you get healed up, man. Appreciate you out in the field. When the price of gold increases, would they use price gouging controls on bullion websites? Maybe you can help answer this, but Jack, I think the gold's going to go up, especially when the dollar.
Hey, now we're thinking outside the Keynesian box there, JJ Watts. Since price controls are on the menu, why not price controls for gold bullion as a way to try to control inflation? I like the way you think it won't work, but hey, let's not let things like it's never, ever worked interfere with a good old conspiracy to gin up emotional string yanking and economic illiteracy. Oh my, I went on this long rant this week about just how economically illiterate we are as a species. And I try to stay away from politics on my channel if I can help it sometimes, but it reached such a fever pitch. It really is sad that we're talking about price controls and food in the United States of America in 2024. It is so predictably a failure mechanism. It has never, ever, ever worked. It has been a disaster for the average person, in particular the poor, every time. And yet we're really talking about doing this. And look, JJ, to your point, it's not a coincidence that gold closed at an all-time high on Friday because of this economic stupidity going mainstream. I mean, these things are related here. So they can try to control the price of gold. They're just going to make the inevitable outcome even worse. Did I even answer his question? I don't know. Went a little tangential there, but
I'm on mute. JJ, thank you for the super chat. We got one more here.
Thank you, TA.
Travis and maybe Mitch but in one of your videos, a statement was made that CPAP, the breathing, I don't know if that's, okay.
Use PAP. Use PAP. About. Yeah.
Use PAP.
the snoring machine, right?
Okay.
Okay, the CPAP is required to be followed. Is the federal law and our CAD's states not following it? Do you have a list? Yeah. So I guess this one's to me. First of all, TA, thank you for your support, brother. We really appreciate that. We don't do this for money, but all the support helps. What you're going to want to do, TA, if you really want to dig into what's going on with the fraud and corruption with the central appraisal districts, go to Mockingbird websites or go to any one of my videos on my channel at Real Estate Mindset and just click those links. There's a whole bunch of videos and evidence and violations. And the video I did yesterday, Melody, you may have watched it, but the video I did yesterday is saying they're not even, some of these states that were supposed to adapt USPAP, the appraisal standards, haven't even adapted it yet. They're just using the law to back in. And here's the problem. We have a right to be fairly taxed. Okay. I have a right as a citizen to protest that tax. What the CADs are doing is they're coming up with a budget and they're backing into that number that they need. You can't do that. You can't do that. You got to give me a fair shake. And on top of that, what drives me crazy, guys, and I'll shut up, I'm sorry, they bully people, those ARBs, when you go to protest as a homeowner, and I've done this myself, they will bully you, they will embarrass you, they will manipulate you. They are not there to support and defend the taxpayer as they are supposed to. In other words, it's just, there's a list.
No taxation without representation.
There's a list. T.A. Chapman. Go to my channel. Follow that link. It'll take you to Mockingbird. There's probably months of data, and then email us as well. And thank you for the support.
By the way, real quick, just to catch people up, USPAP or USPAP, that stands for the Uniform Standards of Professional Appraisal Practice, USPAP, and it was codified into law in 1989. So yes, it is the law. Appraisals for working for the county districts are required to use these uniform standards for appraisal as their basis for coming up with the value of homes. And as Mitch and Travis have been very beautifully illustrating in their videos recently, they're not using it. They're breaking the law.
Well, but not only that, some of these states haven't even adapted it. And when I say adapted it, you're supposed to take it through a procedure to allow the public to comment on it. And they haven't even done that. So, and then also they keep switching, Jack Melly, to what fee appraisers do, and then to mass appraisals. Mass appraisals and fee appraisals are different, but the CADs are using both areas of those formulas again to back, like they're picking. Now I'm going to use mass. Now I'm going to use the USPAP, and they're picking what they want to use again to back in. And do you want to know how much that chief appraiser in that little town makes? He makes actually quarter $250,000 a year, I think. So like $20,000 a month. And he can't be honest. It's just absolutely shocking.
Well, government is getting a lot for their money, aren't they? Pretty good deal for the government.
No, man. Not so much for my children, though.
No, sir.
All right, Melody.
Is it my turn? Are we there? Okay.
Yes.
I think you're up, Mel. Yep.
Excellent. Okay. All right. So I'm hoping if you want to share my screen, Travis. So I'm hoping not to bore everyone to tears, but we're going to do a little deep dive into China because as you could see in Jack's This Week in Doom, China played a very large role this week. And it's the second biggest economy. It's going to play a huge role in what's to come. And just like the Japan story, we all need to be focused on it. So I just want to do a little history. You guys probably remember that the China reopening was supposed to be a really big deal. You guys remember that, Jack and Travis? And it felt kind of
the resurgence. Absolutely. There was going to be this big boom in consumption and it was going to create all this oil demand. I remember the China reopening. Yeah.
Yeah. Everybody got super excited and it just kind of, went away very quietly and very quickly. And so, some of the things that are going on. And so this is June of 2023 that this story is up. And this is over a year. And one of the things I wanted to kind of emphasize is just how long some of these things we're talking about take. And so, it can take a really, really long time for the impacts of these macro headwinds to really show themselves, but it doesn't mean that they're not important, right? And so one of the things here that I think is so an area of concern is that urban youth employment, over 20%, guys. Think about that. Think about what that means. Think about what that means for your society. if folks can't. And then also, because of the one child policy, the demographic situation there is just completely abysmal. And so there is a lot that China is having to manage in these headwinds. And so, but what's important, I think, in this story is that we have to go back in history and think about the global financial crisis and how we got out of it. And a lot of people believe that it was really cheap goods from China, as well as the ability to kind of offshore, labor and pay less for it. That really was what sort of kept us puttering along after the GFC. You guys know, I believe we've been in a silent depression, and so that essentially that recovery really wasn't a true productive recovery. And you can see that in the trend line of GDP, or gross domestic product, where it was broken after 2007. And so we all thought we were okay to some degree because we could buy cheap Chinese goods, right? So think about Five Below. Think about, the dollar store, Dollar General. I mean, this is a lot of electric goods, things of that nature. It felt as if people were doing a little bit better than we really were because of those cheap goods. And so, but the biggest thing to understand is that China is now not in a position to help. In fact, they're going to contribute to. So I want to stop right here, though, because I think this is a really important point. And I want Jack or Travis, if you remember, kind of what the role that China played in the last recovery, and have any thoughts about it.
Jack.
Yeah, well, I can tell you in the last recovery, I'm assuming we're talking about 2008.
Correct.
China actually softened the blow because China never really participated in the GFC. Maybe that's not 100% accurate. I'm sure they were hurt partially, but a lot of investment capital flowed into China, and a lot of the globalization and the outsourcing of manufacturing from the US into China created a lot of deflationary and disinflationary impulses. So we never got the boom in inflation that maybe we otherwise would have seen from all the money printing in QE 1, 2, 3, and however many else that they did. The Amazon effect also played a role there as shopping went more global versus local. So there was a lot of disinflationary impulses that allowed the cannonballs and the bazookas of liquidity that didn't translate immediately into consumer inflation. And China was a big reason for that. That will not be here this time around. So it's important to keep in mind.
And there were a lot of deals made. A lot of our Congress went over to China, and really many people look at this time period as what's really wrong with our economy, that, we kind of offshored that labor. It happened at every single, so we can bring it to the housing market. I remember very clearly in 2008, you had to tell people if you had a high offshore percentage of labor, that was a big no-no with Fannie Mae and Freddie Mac. In fact, they dictated behind the scenes how much offshore you could use. That changed completely after the GFC and was encouraged. And so now a lot of that mortgage work is done actually offshore for cheap. But this is what's happened, is by doing that, we have really hurt our economy. But China's not going to be here to save us this time around. That's the important
Melody,
point. Yeah.
There was one thing I do remember. I mean, just for the viewers, China was kind of like the suspension system during the GFC. And another thing, though, that I want to point out is back then, China was willing to be the suspension system. And fast forward to today, we are now forcing China, well, at least the public, right? Who knows what's going on behind the scenes, but we're now forcing China to take the hit. It's completely different. The whole world is messed up right now. Before, the whole world wasn't messed up necessarily. It was kind of isolated into our housing market. And can you correct me if I'm wrong, but did China purchase mortgage-backed securities back then?
I'll show you in a minute. But, okay. Essentially, guys, so what's been happening, though, one of the ways that China juiced its economy was by really through its manufacturing. We'll talk a little bit about steel in a second here, but they've overproduced so many different goods, and now the entire world has to consume those goods. And so we'll talk a little bit about what that means and cover a couple of confusing topics. And so what's interesting though is also because of that control. So China essentially wouldn't let US dollars come into their market the way that maybe some other developing economies would. And so essentially, the way that they kind of have participated is in that treasury market, right? And we talked about this in essence, like we look at Japan, we look at China, and I'll show that graph again in a few more minutes. But they are the largest holders of our debt, and so that is really important to think about. Kind of going back to that discussion we had on the 10-year, just if China is going to be able to participate in the bond markets that they in the way that they have previously, and what does that mean for that 10-year treasury rate? Okay. So, all right, now we're going to speed up a year and we'll go back to May. And this is when, if you guys remember, China really started having to intervene in their housing market. It was going kind of crazy. You had Evergrande, Country Garden. These developers were imploding. People's money, essentially, their houses weren't getting finished, and it was a nightmare. And so in May, they basically came out with some steps to try to control that housing market in China. Now, I would encourage everybody, as we go through this story, think about the similarities between China and the US, because we also have all kinds of intervention in our housing market. Just before the show, Travis and I were talking about the Biden-Harris or the Harris plan for the $25,000 in FHA. Well, guess what? We still have $5 billion unspent homeowner assistance funds out there in the States. $5 billion, guys. And so we have been intervening by giving this down payment assistance. And so China kind of tried to step in and do some things like making the local governments buy homes and things like that. Just want to pause here, guys. Anything you want to mention about the Chinese efforts in the housing market in May?
Yeah, I want to mention something. I mean, you just hit me in the face with some like truth bombs right there. You know, we get a lot of people, and there's some points here to be made, but I've had debates with people that said that if the housing market crashes, that the Fed is just going to print its way out of the housing market, right? Or the housing market crash, you're going to print money and stimulus. And I think that's actually true. There's going to be some type of stimulus, but you just hit me with something like China's been doing that the whole time. China's socialist communist country. They've been printing and bailing out and manipulating things this whole time. And their housing market is just destroyed. It's burning alive. I mean, we're watching it melt down. So what that demonstrates to us is you can't just print your way out of problems.
I would add that China is in for a massively deflationary correction in their housing market. The numbers are just so freaking big here. I think the average Western mind, and using our experiences, I don't think we're mentally equipped to really understand just how big the problem in China is. Tens of millions of empty apartments, entire cities with no people, poorly built, tofu dreg construction. And on top of that, what we're about to see is something the world probably, I mean, I don't study demographics, but I don't think we've seen anything like this since World War II, or maybe even the bubonic plague, where the population collapse like it's about to in China. So you throw less people on top of that. I don't think there's anything the Chinese can do to stop it. They could slow it, maybe soften the blow or move the risk from one place to another. But that deleveraging has to happen, and there's no stopping it.
Yeah. And it's and what I would say, you know, so 4.2 billion square feet of housing for sale. That is, just to your point, you know, Jack, too big to even kind of comprehend. And we did a show, if you guys remember, we talked about the tallest vacant apartment building is in China. They built it thinking that they were going to get in a city where nobody could afford luxury apartments, but thinking they were going to bring people there for polo, if you guys remember that. And so, but what I would say, guys, in the 10,000 miles, more than 10,000 miles that Travis and I have traveled this country, I have seen very similar things. And I know that is crazy, but I've seen high-rise apartments that are empty. You look at Lakewood Ranch, when that thing is complete, you will understand what we're talking about. Hopefully, Travis and I will get there soon. We're going to come up with a way that maybe you guys could sponsor that trip. but that's something that Travis and I are really trying to do. So I just want to say that it is bad in China, but guys, it's bad here too. And our official numbers are making that impossible for people to comprehend. Okay, so that was in May. Yeah. So then in July, basically, they have their big meeting at the plenum, et cetera. But the important thing about this is housing. Once the ticket to wealth in China, I would just replace the United States, is now draining fortunes, right? Okay, because similarly, they believe like that wealth effect that we've talked about here, right? That if you look on Zillow, you look at your Zestimate, and even Jack talked about it last week, and you see that big number and you think, oh my, I am super rich. I can go out and spend money like I'm a millionaire. The problem is that money isn't yours till you turn around and sell it. And what I have seen with so many people here in the US is that they bought those 10 properties. And even people who have made record amounts of proceeds in Florida, you think, oh gosh, well, now that's just more money being pumped into the economy. The problem is they'd already spent it. And so much of, and Travis, you mentioned this, so much demand was pulled forward that we're in for some really tough times. And this is also kind of what happened in China. So this real estate crisis is huge. And this sentence, I think they are not alone with 70% of family assets in China stored in property. Every 5% decline in prices could destroy as much as 2.7 trillion in wealth. Bloomberg Economics has estimated. Okay, so very similarly, we know that really, in reality, I've seen stats that 85% of global wealth is real estate, and so much of our wealth, and I don't have the percentage, but is really in our homes. Jack, did you want to say something?
I'm muted. Yep. I've spoken about the wealth effect. I was looking for the chart. I couldn't find it just now. We noticed a significant slowdown in spending among consumers in the United States during the GFC, and that's directly attributed to the wealth effect. Case Schiller and one other guy studied it. I've referenced this before. There was a very big slowdown. When your home goes down in value, you feel less wealthy. Even though here in the States, we are pretty evenly split. The average person here, I'm saying middle class, what's left of the middle class, has about a third of their wealth in a home, in the stock market, in the bond market, right? You've got your home equity, and then chances are you've got a 401k that's probably pretty similar to your home equity, and that 401k is split between a 60-40 stock bond portfolio. So the average person is pretty evenly split between those three major asset classes. It is not like that in China. In China, the average household wealth is over 90% real estate. So if a decline in home values in the United States here causes a big slowdown in consumer spending, where it's only about a third of our wealth, then what is it going to do in China where it's 90% of their wealth? The wealth effect will be even more significant. And that's why that story about that I mentioned in This Week in Doom with the collapse of these convertible bonds, I think that's just the beginning. That is these defaults in real estate starting to spread to other consumer categories. The deflation we're seeing in China, the slowdown in consumption, the wealth effect is playing out, and it's only getting started. It's going to be very severe.
Agreed. And yeah, so thank you for that stat. So 33%, that's still, very large percentage. And housing is about 12 to 16% of GDP. So it's very impactful, right? So we get to August, which has been very eventful for China. This is what, Jack had referenced on his show. You did such a great job this week, Jack, on talking about China. You inspired me. But that intervention in the bond market, because they're basically saying there was a bubble, and essentially they told folks not to honor trades, and so to renege. So let's say you bought a bond, then basically you didn't really buy one. They did not let you have it, and then the next day, I think you quoted this on. Jack. Was it 800 million left the bond market the next day? Essentially,
yeah, it was the bond market ETFs saw some pretty significant outflows the following day, and that's not by accident, right?
Right.
when the government is going to rig the bond market against you, you probably don't want to be in a bond ETF. So people started selling it.
Right, right, exactly. And so they're really trying to control those falling yields. Okay. Another thing that I just wanted to talk about this is slow economic growth and tight capital controls have concentrated domestic funds in China's government bond market, one of the largest in the world. And so this is showing you how concerned. Can you imagine if this happened in our country, guys? But this is, I mean, what we're seeing. But again, we know our politicians might also be sort of operating in our markets as well. We talked about that activist treasury issuance by Yellen last week, but this is pretty extreme to to basically cancel trades. But at the same time, we also in our stock market plunge, somehow all of those trading platforms didn't work either. So again, we always want to point fingers at China. I think we have to also have some perspective as well. Okay. So then this week we hear foreign investors pulled record amount of money from China. Okay. So this is huge, huge numbers. If this decline continues for the rest of the year, it'll be the first annual net outflow since 1990. Okay. This is a big deal. And I think that date, Jack, you might have some things to say around this 1990s, the 90s. I think that is an important time frame, right? That when we really saw our relationship with China start, getting bigger and bigger. Essentially, I think this is when things sort of opened up and we really were starting to kind of, offshore a lot of our labor and also import more of their cheap goods and relaxing those restrictions. So, this is, I think, a historical kind of turn and change in direction than what we've seen in the last, basically 30 plus years. But what do you think about that, Jack or Travis?
The 90s, I found that kind of curious. Why does the data go back to 1990 and that's when they stopped? I guess there was no real reason to track it before then, because you're right. That is when the outsourcing really started to gain. I mean, outsourcing started arguably in the 70s and the 80s too, but it really hit its stride in the 90s. And by the early 2000s, it was just, like the bathtub was totally draining from the US into China. So I'm not too surprised. I think if you go back earlier than 1990, maybe you see a lot more common to see negative numbers back then. But it does show how far we've fallen since the 2010s. And,
Right.
That foreign capital flowing into China blindly, it's gone now. It's not going to be there this time around.
Yeah, I'm thinking, I think too, when did it, and it wasn't, I think it was really big manufacturing really started in the 90s in tech, right? I think a lot of the tech manufacturing, things of that, but definitely, you can look back, and this is why, as much as we hear about trying to control China, there are a lot of our people in office today who owe China quite a bit. And so this is one of the reasons why a lot of the Chinese money was saved during SVB. That was even, they don't talk about it much, but there were a lot of folks who had the Chinese had a lot of interest kind of behind the scenes. And so they were saved there. And I think our politicians are in cahoots with China on several different trade things. And essentially, when we think about how much people want to clamp down on this Chinese relationship, we have to remember that. Anything you want to add, guys? I know just around the sort of political.
The writings on, I would just say the writings on the wall with China. I'm surprised investors even invest in China with all the data manipulation. But, listening to this, Melody, it really makes me sad. Because it doesn't matter, like what happens with, like we're talking about China so people understand here what's going on, right? So they can have a more cautious approach, but it doesn't even matter. What matters is what's going on in my household. I can already feel the recession. Why are we talking about, you see my point? I'll shut up.
Okay. And so what do you mean though, Travis? Like, why are we talking about?
Well, because I think what people should be paying attention to is like, the debt, right? Like their own household. Are you guys in credit card debt? If you're in $5,000 in credit card debt right now, you have a potential financial emergency brewing, right?
Yeah.
Like that's what to me, that's the only thing that matters. What's going on with the consumer? What can we do? Do you see? But we have to talk about all of this stuff, because we're up to bat against the mainstream media, always saying the economy is doing great, stock market new highs. My thing is like, why does people care about the stock market all-time highs when they're not even investing in the stock market, Melody? Just have such an issue with all of this.
Well, there's just a lot of narrative, right? But I think why we're talking about China, and we'll get to this, is that these headwinds from China could really exacerbate what we see coming. That in terms of the recession, this could be much worse than what I think a lot of people are understanding. And we're going to talk about some complicated things here in just a second around trade surplus and things like that. So I hope everybody hangs in with me. But the reason we're talking about it is going to tie into what Travis just said. You do not want $5,000 of debt. You don't want any debt for what's coming our way here. And China's going to play a big part. Okay, so SAFE. SAFE is an entity that essentially it stands for State Administration of Foreign Exchange of the People's Republic of China. And they report on kind of the flows in and out of the country. And they recently, or not recently, I think it was in 22, they made a change in the way they were calculating those flows. And as such, what people have started to see is that there's a big, people are looking at customs information, and they're looking at what China is saying about their trade surplus, and they're seeing huge disconnects in that. And we'll talk about why that's important in just a second. But I want to stop with also, what is a trade surplus? And so it's an economic measure of a positive balance of trade where a country's exports exceed its imports. Okay. And so essentially they are exporting more than they are taking in. And this is all going to be very important. So bear with me. And so I just wanted you guys to understand those terms really quickly. So what essentially people think that China is hiding its trade balance, and why they would do something like that. That's what we're going to talk about. Okay. So Jack also covered this story earlier in the week. So did Eurodollar University. He did a great piece on it. But essentially, the world's top steel producer warns of severe industry crisis. Okay. I think you did a great job with this, Jack, when you're like, winter is coming. This guy, Hugh, is kind of like the Ned Stark.
I think they even referred to this as a Stark message.
It is.
I don't know if that was on accident or not, but the Game of Thrones references were just over the top here. Yeah.
Right here, Hugh's Stark message will likely be a worry for rivals across Asia, Europe, and North America as they grapple with a fresh wave of Chinese exports, often by pushing for trade measures. Shipments from China are on track to reach about 100 million tons this year, the highest since 2016, as producers there scramble to offset a domestic slowdown. So what is China doing? They're taking all of this excess steel they've produced and they're dumping it on the rest of the world. And what happens when you have oversupply, guys?
Prices go down. Yep.
Prices go down. Okay. So that's what's and so China's about to just wreck the steel industry, essentially. And so for a really great video, I would recommend this from Eurodollar University going into this steel collapse. Okay, now this goes into a research paper about how China's overcapacity holds back emerging economies. Okay, and so we're a developed economy. What have we done, Travis or Jack, to try to get control over this China situation?
Make the situation worse by printing money.
We've also done things like we've done tariffs. We've tried to subsidize our own steel industry because it was one of our biggest military edges in World War II. And the Chinese have bankrupted our steel industry with their dumping. And now if we ever need to, I don't know, hypothetically build a lot of ships to fight the Chinese, well, we can't because we can't make steel fast enough. So this overlaps with U.S. government debts, with military spending, with deficits, with the bond market here in the States. It touches a lot of different things here.
Yeah. And so forgive me, everyone, but I'm going to read this really quickly. Since 2019, weak domestic demand and expanding industrial capacity have combined to balloon China's manufacturing trade surplus. While growing Chinese exports benefit developing countries to some extent by providing inputs for their local industries, they also contribute to China's rising market power, creating new vulnerabilities for the developing world. It has long been assumed that China's rise up the value chain would create a growing market for labor-intensive manufactured goods from other emerging markets. These hopes will be dashed if Beijing cannot restart the engines of its own domestic growth and absorb more of what it currently exports. Unless Beijing implements serious demand reforms, developing nations will be crowded out of manufacturing by Chinese overcapacity, leaving them dependent and without export opportunities. And so this is going to have a huge impact on, these nations. And so the other thing that's really, really important is this domestic growth story, right? And I'm going to ask the question at the end of this segment, why do we think that China is hiding its trade surplus? If they are, but that domestic demand is just not there. And so they are dumping this out onto the market. And so let's see, here's some really good charts on kind of what's, essentially the trade surplus as a percentage of the recipient GDP. And so we are fairly okay compared to some of these other nations. But you can see that some of them are very imbalanced. India, for instance, has accused China of going through Hong Kong to basically mask that they were pushing their products through Hong Kong instead of mainland China. So this is a very precarious situation for the rest of the world. And I think one thing that I'd like to mention here, and I'll read this really quickly, China's dominance over so many product categories creates, first and foremost, a risk of economic coercion, where the government restrains access to crucial inputs for political leverage. Examples already exist, from rare exports to Japan in 2010 to more recent export controls on solar panels and other technologies, and reported denied access to solar equipment in India. So with that market power, it's able to really, kind of use brute force, act like a monopoly out there to the detriment of other countries. And then I just want this last point before I ask you a couple questions, but another significant variable is likely to be how China manages the exchange rate in response to trade restrictions. China could try to respond to Western tariffs and trade defenses by letting the currency depreciate, creating incentives for a further rise in its exports. And so what this is saying is that there's a few ways that they can try to manipulate this situation and make it worse. But Travis and Jack, I want to stop there before I move on to the next part of the segment.
I mean, the only thing I have to say, just to respond to what you're saying, you're like, why hide the surplus? I mean, it's clear, right? I mean, I think we understand why they would, to maintain control over economies and to maintain being able to manipulate that. Look at COVID. I rest my case, Jack.
It's also important to point out here that if this ever does come to open conflict with the U.S. or with the West, which, unfortunately we're like sleepwalking backwards into World War III right now. Part of the U.S. plan is to blockade the Malacca Strait, which runs right past Singapore, where 80% of China's exports flows through, as well as most of China's food imports flows through that little strait. There was a very famous submarine deal, AUKUS, with the Australians and the UK that we cut a few years ago. And the French were all upset because the U.S. was going to sell submarines to the UK and Australia. That's all around positioning submarines outside the Malacca Strait to blockade China's exports and strangle them economically if it ever comes to war. That means shortages of freaking everything because, as Melody just got done talking about, the Chinese have been dumping manufactured goods on the open market. This has been going on for decades, capturing market share, and this stuff isn't made anywhere else. So something to think about.
Yeah. So, okay, moving on to the rest of the story. So this is just this was a great tweet that came out from Brad Setzer. It's almost impossible to describe how weird China's Q2 balance of payments data is. The basic balance, the current account plus foreign domestic investment turned really negative 30 billion for the first time, despite 190 billion customs goods and services surplus. That should not happen. And so what he is again pointing out is that he believes that this trade surplus is much, much bigger. He goes through the three reasons. The inflection point in this series is Q1 of 22. Three things were true. China's support for Russia's invasion of Ukraine focused minds on geopolitical risks. 2, Fed started tightening while China was easing. And then 3, SAFE, that's that agency I just told you about, stopped using the customs data to calculate the balance of payments. And so, this is a great tweet. We'll put the link in the show notes. But essentially, he believes the balance is much, much higher, and that the IMF, with its thousands of economists, recently did a report that said that these balances were receding. Okay, they weren't growing, and what he is arguing is that the IMF and everyone out there thinks that these trade surpluses were getting run out, and the opposite is actually true. That's what he is saying. And just quickly, what is that CA balance he's talking about? Is the current account balance is part of a country's financial inflow and outflow record. Is part of the balance of payments, the statement of all transactions between one country and another. So that's what he means there. So now I get to Michael Green's excellent Substack this morning. And he just sums it up really nicely. So I'm going to use his words here. China's economic shift, the decline in foreign direct investment and capital flows into China further signal the end of the China story. As economic conditions worsen despite rising productivity, the rest of the world will not absorb China's domestic excess capacity, and the unwind has the potential for a Great Depression-style event centered in China. He goes on to say, this surplus is the source of the world's increasing anger at China. I reiterate that a Great Depression-type event awaits China as the world increasingly refuses the imported unemployment and debt required to offset China's increasingly overstated GDP and understated exports. When China exports are restricted, China demand and income falls. If the mechanism is tariffs and trade barriers, then yes, prices in importing countries will rise, and we will see another one-time increase in the price level for many goods imported from China. But unless this increase is accompanied by an increase in purchasing power, what have we all been talking about? What were you just talking about, Travis? We are not increasing purchasing power right now. Through labor incomes, and he does say, or government transfers, the net impact is an aggregate decline in economic activity and an inability to purchase as many goods and services globally. Hence the Great Depression analog. You may firmly believe that another COVID-style stimulus is incoming, and you are entitled to that opinion. If it occurs, I agree it will be inflationary, just as the COVID stimulus created surplus of demand relative to available supply, but the precipitating event will be deflationary. Okay, so I want to stop, guys. What do you think about what Mike Green said?
I think that's personally, that's incredibly powerful. It's another data set that would suggest that it could be a very bad downturn. And, and I've been down that rabbit hole, Melody. I look back at 2012. I was talking to Jack, the Operation Twist, when they started purchasing mortgage-backed securities again. And if you look, the markets rebounded then. So going back to the pulling demand forward, I think they've been pulling demand forward since 2012. And you can see that when you look at negative equity held by residences. The negative equity didn't really reverse until they started doing quantitative easing again, which manipulated the markets and pulled in demand. And so how much, there's not enough demand. I don't know how, and this is, again, it hits me in the face because it's just something I haven't considered. It's another issue. It's something I should prepare for. It's just all telling me, Travis, don't spend your money right now. Do the best you can to rebudget, to save money, and to stay focused on your goals, stay disciplined, love your family, love the relationships in your life. That's what that story tells me.
Yes, absolutely. Jack?
I'm a big fan of Michael Green's. I like the way he thinks, and just the phrase there, the way he puts things when he mentioned how countries, what did he referred to it as imported unemployment.
I love it.
The world
Such
increasingly refuses imported unemployment, and that's a great way to think about it. And it's the way his mind works. Yeah, that cheap crap, right? The cheap coffee makers and blenders that break in a year
Right.
that we've been buying from China. Well, we haven't just been importing crap. We've been importing unemployment. The world is now wise to that and pushing back against that. So that's just a compliment to Michael Green and the way his mind works. I really enjoyed that. And I agree, China is a massively deflationary story. I think the press is underreporting it for whatever reason, probably because the companies that own the press, I don't know, like hypothetically an ABC News also happens to have a movie coming out at Disney that they really want those Chinese box office numbers, and reporting critical data about China is a way to get your movie censored. So, there's competing interests in the media at work there as well. But
and our politicians, as I mentioned before, there's a lot of financial interest in this relationship with China. So even though, we hear things about tariffs, a lot of our politicians have financial interest in China. And like you say, so does our financial media. Yeah. So I couldn't agree more, Jack. Like, that line is just so incredible. Refuses the imported unemployment and debt required to offset China's increasingly overstated GDP and understated exports. Just an incredible piece.
Jeez.
I encourage everybody to watch it. Read it. Sorry. What, Travis?
No, it is very powerful. And I ask myself also, what else are we not looking at, Melody?
Yeah, 100%. So, all right, I'm getting close to wrapping it up here, guys. Thanks for being so interactive with me because this is some dry stuff, I know, but I think this is so important. So, China new home sales struggle in face of lopsided recovery. U.S. new home sales are struggling as well, aren't they? Oh, yes. Lopsided recovery. Okay. And so, all of that government intervention, and Travis, you hit the nail on the head with your point earlier. All of that government intervention is not saving their housing market. It's not saving it. China is really struggling. We've seen things, and I forgot to add some slides on this, but you can look at luxury goods, Gucci, a whole bunch of retailers are doing very poorly because of the fact that China consumer has pulled back. And so, not only are they're pulling back out of our luxury markets, but they're pulling back at home as well. Okay, so next slide. This is where, again, I just wanted to remind everybody that Japan and China are massive holders of our debt. Okay, and when they are so overly when they have to become very concerned with their own house. Remember, it talked about, in fact, trying to manipulate their currency. They are going to have to do things or participate in a different way in our bond markets. And this could actually keep rates higher than anyone expects in mortgage. Meanwhile, as Travis was just showing you, Redfin, Realtor.com this week, everyone is talking about realtors get ready for that massive drop in rates. Well, guys, I don't know if it's going to happen the way that everybody thinks it's going to happen. And so here you can see, Travis, Japan and China are the top two holders of MBS as well.
Crazy.
So, okay, now this is the final point to this story. So we have heard international buyers are pulling back from the U.S. housing market. Okay, basically 36% drop from the year before. I think a lot of us know this. It's concentrated in California, in Florida, Arizona, Texas. And of course, the biggest buyers are typically the Chinese in the U.S. housing market. And they are paying those top dollars. And so this CNBC mainstream article talks about the fact that that's being pulled back. So now here's what I think is interesting. The big question, are they selling? Okay. And a lot of people, when I talk about this, are essentially say, no, they'd never sell it. They want to hold their wealth here, but not if they are under stress. And so anecdotally, I have heard from people in Florida that the only people listing are the Chinese. I've heard stories from California. So are they selling, guys? Could this be some of our motivated selling? Not our distressed selling, but some of our, in essence, it could be distress. Like Travis said, we don't know how much. But here from a comment on Adam Taggart's YouTube, he sent this to me. I'm in Australia and my part-time neighbor is a Chinese family of some substance. He told me this week he's selling about 30 apartments to take cash back home. It's approximately half of his property invested here. He's doing it because he can buy in back home at ridiculously low prices now. He bought one place recently back in China for a fifth of its build costs. Sellers there are beyond desperate. Nobody is building or speculating by building. Most developers he knew are broke now. Many lost everything. Okay. California was a very interesting outlier this month in July data. Okay. They're seeing year-over-year sales up significantly. And there's a reason for that, what was going on with some of the tech layoffs last year. But month-over-month sales, their sales have been very strong. Part of it, I do believe, has to do with the sentiment, as we say, Travis. But here's what's important. That year-over-year price is up. We're seeing that everywhere. But that month-over-month price is down. And guys, California has a very different season than Florida. And their prices should not be coming down right now. Between June and July, prices on average increased 0.50% in California if you go back since 1987. Okay. And that's the data series that I have. And so seasonally, prices should be going up. So I believe what we're seeing is motivated selling in California. And it could potentially be driven by some of what's happening in China. And that, my friends, is the end of the segment. Jack and Travis.
I got a super chat I got to throw up. But Jack, do you want to comment on anything that she just said? Maybe like the 43% of inventory year-over-year growth, which doubles the national inventory growth. Anything?
Do I want to comment on that, or do you?
No.
Would you like me to elaborate on that?
Yeah. Go ahead.
Melody, excellent presentation. I love the amount of data in that. I really like that Michael Green quote. And the question about forced selling here in the States, capital being repatriated to China, that's new to me. I've seen a lot of stories about capital flight and China trying to control capital flight. This is the first I've heard about capital flowing back into China as they suffer from deflation and prices going lower there. And that one data point was really potent. What did the guy say? A fifth of the build cost. So we're not even talking about an 80% decline in asking price. We're talking about an 80% discount from the cost to build the freaking thing. Wow. And how'd you like to be a builder in China right now? What do you think his prospects look like?
It depends if you have money.
Yeah.
If you got money, then you're doing well.
If you're a builder in China,
doing well.
you don't have money right now. I can tell you that. That's for sure. Yeah.
Great. Yeah, that was a great report. Sorry I didn't say that. I was actually blown away by that, Melody. That was really good. Good job.
Thank you. I hope it wasn't too boring. Okay.
No, it wasn't. It was excellent. And Travis, we had a super chat that we missed also.
Oh, yes. Let me throw that up here. Now, if we could start with you, Jack. JJ Watt, again, thank you for all you've done for Houston. Thoughts on the upcoming BRICS October meeting?
I think BRICS is such a PR stunt and such a bunch of hot air. I really do think the BRICS countries don't like us being the U.S., the West. That being said, they also hate each other. And you know what? Oh, you don't want to do business in the dollar anymore because you don't trust the United States. So you're going to get into bed with China? Okay, good luck. Enjoy that. They're only the biggest human rights abuser in the history of freaking mankind. I'm sure it's going to end really well for anybody who gets into bed with China. But could you share my screen for a quick second on this comment? Thoughts on the upcoming BRICS meeting. This is an article from back in 2023 in the Wall Street Journal. A bank China built to challenge the dollar now needs the dollar. They're talking about China's new development bank. and they called it the BRICS Bank when they created it. All right, it was the bank that was going to finance expansion in BRICS countries without the need of the dollar. How's that going? Well, when Russia invaded Ukraine, no Wall Street institutions would lend dollars to a bank that was 20% owned by the Russians because of the ejection from the SWIFT system and everything. Next thing you know, this new bank that's all about de-dollarizing is so desperate for dollars that they can't make loans anymore. So this is a case study in how de-dollarizing sounds great. And yeah, we're going to do it. And look, a lot of my friends, the gold bugs and the silver guys, are really gung-ho about this BRICS thing. Guys, it's like a teenager who thinks he can move out of mom and dad's house. It sounds like a great idea. And then you go to do it and you're like, oh crap, this is really hard. And I think de-dollarizing is the same way. The dollar is the world reserve currency. And if you're trying to do business without it, as China's new development bank found out, it's really freaking hard to do. So I think BRICS is a bunch of hot air. We've been told for years now BRICS was going to have a new gold-backed currency and it was going to replace the dollar. And we're further from that now than we ever were. So that's my take on the BRICS comment.
I got a comment, but do you want to break anything down? I'm going to say this, Jack, because I was leaning towards what you were saying for a long time, but then I asked myself this question. First of all, we have to understand that the dollar is a weapon of mass destruction. The dollar is what the U.S. is using to bully their way around the world, policies, whatever, sanctions, tariffs, whatever. The dollar is very powerful, and the world's getting sick and tired of what our politicians are doing to them, and I cannot blame them because it is a weapon of mass destruction. And then this question is what I would ask you, Jack. If they could, would they?
If they could, would they?
Yes. If they could, that's right. And that's what concerns me, because we don't fully understand how much devaluation of the dollar is really going on and how PO'd the rest of the world is at us. So when I asked the question, would they switch the currency if they could? And that answer is yes, my friend. So the question then is who's going to win first? And so although right now they're a bunch of teenagers huffing their, puffing their chest out like, yeah, we're going to get them. Yeah, they're going to get beat up. Right. But that doesn't mean a decade from now, 2 decades from now. And then when we look at the fraud in the US and we look at the taxing, we look at everything. I think that there's going to be eventually, I don't know when, Jack, but there's going to be some type of new currency. I don't know when. I don't know enough about it. But
I can tell you a little bit about this. I've studied transitions of world reserve currencies in the past. And every time there has been a passing of the torch, it hasn't been an instantaneous thing, by the way. It plays out over decades. But every time the world reserve currency has changed for the last, we'll say 500 years, 700 years, every single time, the new dominant currency, there were 3 distinct characteristics. Number one, the new currency was backed by gold or silver. It was pegged to precious metals. All right. China, Russia, they're not going to peg their currencies to precious metals. They need to print money to get out of a real estate crisis. They need to print money to fund wars. Oppressive governments don't give away the power of monetary repression or fiscal repression. So I don't think they'll do that. Number 2, the replacement currency had a global trade network. China, you could argue, has a global trade network right now, but so does the U.S. And number 3, the new currency, the new country's dominant currency, had a blue water navy that could project power in order to enforce that global trade network. And nobody even comes close to the United States on the open seas right now. China does have a big navy, but it is not a blue water navy. They can't operate beyond their own shores. All of the historical characteristics that enable somebody to take over as world reserve currency, nobody is even close right now. So as much as we're abusing the privilege, there's no alternative.
I agree.
I do think, Travis, I'm firmly in the, your view, Jack, but I also agree to some with Travis that we do need to be looking at this as not that it might never happen. We just need to understand it as a risk. And because I think when people saw us seize Russian assets, things really got crazy. And I didn't ask my question, which I meant to, sorry. Why would China be hiding that trade surplus?
Oh, well, Jack, I answered that.
Maybe they're hiding the trade surplus because if they admitted it, the world would be even angrier at them for dumping and suppressing prices, that it might result in more tariffs, more trade restrictions.
Agreed.
That's a motivation to hide it.
I think so, as well as I think it shows how weak their consumer demand is as well. So I think two reasons, but I totally agree, Jack. Okay, sorry. Go ahead.
I think you're up, Jack, for your story. We're running long on our stories today. I like it though.
Well, I only did one, so it's.
I only did one too.
All right. Well, this is my only one story, unless we're going to count this week in Doom as a story. But Trav, if we could share my screen, please, sir. All right, guys. Could you? Yeah, there we go. We're going to start with a little bit of a biology lesson. Who remembers like 7th grade biology when we talked about vertebrates and invertebrates? The animal kingdom is divided into 2 big categories, right? Should I use my David Attenborough impression for this segment? Should we talk about the invertebrates? All right, we got a couple of spineless animals shown here on stage: the leech, the centipede, the octopus, the sponge, the clam, the crab. And then down there in the bottom, there's a couple of lesser known spineless animals. All right, right there in the middle and the bottom row, there's Jerome Powell, otherwise known as Homo federalis, the head of the Federal Reserve here in the United States. All right, next to him, there's Andrew Bailey, otherwise known as Australo-Bank of Englandus. He's the head of the BOE. And the guy all the way on the right there, that's Kazuo Ueda, the head of the Bank of Japan, or Printon Spendicus Japanicus. All right, there's the scientific names. And these are all spineless animals. All right, now why am I saying they're spineless? Because we have had 3 near catastrophic deflationary events in the last 2 years. And all of these spineless animals at the bottom intervened, and they eased, and they either lowered rates, printed money, or somehow interfered with that deflationary impulse in the market, and they did it in a very inflationary manner. Now, I am 100% in agreement, and what Melody just talked about with Michael Green earlier was an excellent segue into this, how he talked about China is barreling towards this Great Depression, this deflationary event, but the central bank impulse coming out of that event is going to be a bazooka of liquidity. It's going to be to print more money. And so it's going to result in a much bigger inflationary impulse once the central banks get involved. And I think the West is doing the same thing, the same exact thing, because of these spineless central bankers. All right, here's the inflation rate, right? Inflation has come down pretty sharply. This is CPI year over year going back to 2020. All right, we had the big inflation scare. It came down. Inflation now, it's dropping very slowly. But remember, 90% of the increase in CPI in this most recent print that we got this week, that 2.9% number, 90% of that was shelter inflation. And shelter is a lagging indicator. It's heading lower. And if you take that away, inflation is almost nothing and threatening to go negative. Threatening to. I do believe if the central bankers do nothing, we will have a massive deflationary event. We've already had 3 in just the last couple of years, including most recently. Now, remember also the 1970s, inflation in the 1970s. You see the great inflation there in black. There was 3 distinct waves of inflation. It went up, it came down, then it went up higher, came down, and then it went up even higher, and before it finally came down. 3 distinct waves of inflation because we thought the problem was solved, and then we eased. We did what we always do, and the inflation came roaring back. All right, so our current course, right, this chart right now of CPI, it does somewhat resemble that first impulse of inflation from the 1970s. Now, let's talk about these 3 market accidents that we had and the central bank response to them. The first one, I want to take you all the way back to September of 2022, the UK gilt crisis. All right, this didn't get very much play here in the West. They talked about it very briefly, but I think this shows what the central bankers are going to do. UK pension strategy, that gilt market relied on, becomes big risk. This was September 28th of 2022. By the way, a gilt, that's the British nickname for the 30-year UK government bond. They call it the gilt. All right. They talk funny in England. Okay, let's move on from that. But this gilt market, this big blow up in the UK bond market, it almost collapsed the entire pension system in the United Kingdom. They were hours away from everybody in that country losing their pension. And I'm not being overdoomy, by the way. This is exactly what happened. The UK's pension sector created the modern gilt market. Last week, it almost broke it. For decades, these investors have demanded long-dated assets match their liabilities going out decades into the future, particularly for defined benefit programs, which need to make payments, yada, yada, yada. We get all this talk about the bond market. But last week, that symbiotic relationship in the bond market, it started to unravel. The market saw new Prime Minister Liz Truss's unfunded tax cut policy as fiscally reckless. Pensions which pursued so-called liability-driven investment strategies with leverage faced emergency collateral calls on their hedges as government bond yields soared, resulting in the largest sell-off in history. And the Bank of England, which had been on a mission to reduce its balance sheet, was forced to start buying bonds again to calm the turmoil, sparking the greatest rally on record. So they had this crisis in the gilt market. We'll talk about what caused it in a second. But what did the Bank of England do? They started unlimited money printing in the middle of the night, and they started buying this government debt to bid up the price and to force the interest rate back down. And they had to do it because they were hours away from the pension system in the UK collapsing. Now, I also want to point out something here. They're talking about what caused it. They're saying Prime Minister Liz Truss's unfunded tax cut policy. All right, that's partially true. The UK, Liz Truss did come out with this new plan for tax cuts and no plan to pay for them, which meant that the government was going to have to borrow more money. And if the government is borrowing more money, they borrow it from the bond market. Well, the bond market was already short on liquidity. There wasn't that much money available to borrow. Interest rates were rising. And then here comes the government says, we're going to lower taxes and not cut spending. And so we're going to be borrowing even more demand for money. The price of money goes up. The price of money is interest rates. And this was also a few days after the UK started their price controls program. Oh, there's price controls again. Their price controls program for energy markets, because this was after the Russians had cut off the flow of gas into the UK and after somebody, probably us, blew up the Nord Stream pipeline. So there was an energy crisis and the government was endlessly subsidizing energy for the people in the UK. So deficits were exploding. They had no way to pay for them. And so interest rates started to rise. Now, in the UK, there was this thing called liability-driven investments, which is this hyper-financialized interest rate swap program. I don't know. I don't want to get too far into what liability-driven investments was, but what it boiled down to is as interest rates rose, these pension funds were losing money like crazy. They had made these highly levered bets that interest rates were going to go down forever. And so it helped the pension funds. Their interest, as interest rates had been falling, as they had been for years, the pension funds were making money on this trade. But then when we started to fight inflation in 2022 and interest rates started to rise, the pensions started to lose money in this trade. And they started to get margin called because they were losing so much money in this liability-driven investment trade. And so when you get margin called, you start selling whatever assets you can to raise money. Well, what do UK pensions own a lot of? 30-year UK government bonds. They own a lot of gilts. And so those pensions, as they started to get margin called, they started to sell the gilts. Well, that drives the price of the gilt down, the interest rate up. And as interest rates are driven up, it makes the problem even worse. Oh, now there's more margin calls, and now I got to sell even more gilts. And so the 30-year UK gilt, this is the interest rate on the 30-year UK gilt. At the end of September in 2016, it started to turn upward, and it started to go parabolic. It turned into a feedback loop. These liability-driven investments, the interest rate swaps, were losing so much money. They were getting so many margin calls and selling more gilts to cover those margin calls, resulting in interest rates going higher and even more margin calls, that if it had gone on for a couple of more hours, every single pension fund in the UK would have been insolvent. And that would have been a massively deflationary event, right? Grandma losing her pension, that's deflationary. That's money going up in smoke. That's firms failing, hedge funds failing. And so what did the UK do? What did the Bank of England do? Andrew Bailey steps in and says unlimited money printing, and he bought down the interest rate on the UK gilt. The Bank of England just started buying more and more and more UK gilts. So he showed us this played out in just a matter of hours. In just a matter of hours, the Bank of England decided, I am going to stop raising rates. I'm going to start printing money because we can't allow this to happen. All right. Now, it's debatable. Was it the right choice or not, right? Nobody wants grandma to lose her pension. Nobody wants investments to go away, retirement systems. Pensioners deserve the money that's in their pension fund. But the fact is the pension fund managers made bad bets. They collected a lot of fees and got rich doing it. And the second the trade went against them, the UK central bank printed money and bailed them out. In the blink of an eye, they did it. They showed us their true colors. Andrew Bailey was spineless. All right. Now that was in September of 2022. Didn't get much play here in the West. Just a few months later, March of 2023, the United States had their turn. We had the second, third, and fourth largest bank failures in U.S. history, all in rapid succession. Every time I look at this picture, I say to myself, do you want to build a snowman? I get the Frozen song stuck in my head for some reason. I have daughters, forgive me. But you can see here, guys, look at how big it was. This chart is showing the size of the bank failures that happened in 2023 versus the size of all the bank failures that happened during the GFC and ever since. And you can see on a total assets basis, that mini banking crisis in 2023 was almost as big as the great financial crisis. It was huge. And it was a very quick crisis. It only played out over a matter of a couple of weeks. On that weekend, the government came out and they said bank term funding program. Right now, it was very similar to the higher interest rates that caused the UK gilt crisis. We had something similar cause the blow up of Silicon Valley Bank. This one in Financial Times, Silicon Valley Bank launches $2.25 billion share sale to shore up their capital base. This is the story that started the panic that led to all those bank failures. And this is a pretty common headline here. Oh, bank launches a share sale, shore up capital base. We're strong and resilient. But what actually happened was Silicon Valley Bank lost money selling assets. Silicon Valley Bank, the share sale would help shore up the bank's capital base after losing roughly $1.8 billion on the sale of around $21 billion of securities that were classified as being available for sale, according to its statement on Wednesday. So this bank run started at Silicon Valley Bank. They had a lot of very wealthy tech companies. And when inflation gets bad, there's not a lot of investment in tech companies because tech companies are based on future earnings, and inflation makes future earnings less valuable. So Silicon Valley was having a hard time raising capital back then. And so as Silicon Valley can't raise capital, they start spending the money they already have by taking it out of the bank. And it started to look like a bank run as all of these tech startups start spending down their money. And Silicon Valley Bank says, well, we need to give them their money. Oh, that's right. We invested their money. So we need to sell those investments. They invested in U.S. government bonds. Well, U.S. government bonds were worth less money because remember the inverse relationship between bonds and interest rates. As those bonds got sold, their prices went down and the interest rates went up. And so that started the cascade of failures with Silicon Valley Bank. They lost so much money on that bond sale that further spooked their depositors, their big tech companies. They started to worry that the bank was going to lose money. And so they started withdrawing more money. That caused Silicon Valley Bank to have to go sell even more treasuries, losing even more money. And the bank was insolvent. And well, in the middle of the night, this only went on for a couple of days. Again, the Fed, they showed us how spineless they are. Fed launches $25 billion lending program to prevent a bank run. By the way, notice the headline, $25 billion lending program. Put a pin in that $25 billion number. We'll be back to that. The Federal Reserve, the Treasury Department, and the Federal Deposit Insurance Corporation took decisive action. Remember, strong and resilient. Over and over again, they told us how strong and resilient the banks were as the banks were failing. They took decisive action to stem what was clearly a potential bank run, and it was not a potential bank run. It was an outright bank run. The $25 billion bank term funding program announced Sunday night, this was in March of 2023, was necessary to prevent a much larger crisis that would spread through the financial channels to the real economy and almost certainly tip the economy into recession. The critical point here is that by accepting collateral at par, if a bank owns bonds that are trading at 60 cents to the dollar, it can exchange it at the Fed discount window for $1 in liquidity. This effectively removes the risk of a bank run. So what the bank term funding program did is it allowed banks to lend their assets to the Federal Reserve, and the Federal Reserve would give them par value for it. In other words, face value of the debt. Now, if I had an IOU from the U.S. government, it was only trading. If I had to sell it, I could only get 60 cents on the dollar for it because interest rates were rising. But if I loan it to the Federal Reserve and the bank term funding program, they'd give me the full dollar. Where did the Federal Reserve get that money from? Well, they created it digitally. In other words, they printed money. I know there's people out there who disagree with the categorization of saying the BTFP was printed money, but it expanded the money supply by artificially inflating the value of assets. That sure sounds like money printing to me. And they did it in a matter of days over the weekend. Silicon Valley Bank failed on that Friday. And by Sunday night, we had the bank term funding program. And by the way, that $25 billion program, it reached a high of $167 billion. So how's that $25 billion number working out for you? This is the Bank Term Funding Program. Now, it expired back in March, and it has already started to shrink because those loans are now starting to mature and be repaid. But there's still over $100 billion sitting in the Bank Term Funding Program that's out there that needs to be unwound. But again, the Fed showed us in the blink of an eye, the second things got hard. Oh, rich people could lose money? I mean, if Silicon Valley Bank, it should have been allowed to fail. It was not a systemically important bank. It wasn't a GSIB. It was no JP Morgan, no Bank of America, not even close. But the government invoked the systemic risk exemption. Rich people aren't allowed to lose money. They're not going to get bailed in. And so the FDIC took the hit. And they've done that for every bank failure since Silicon Valley Bank failed, including Republic First Bank that failed just a few months ago. Here in 2024, it was only a $16 billion bank, right? Republic First Bank, if you put it on this chart, it would have been one of these little circles in the middle here. Nothing like these big guys. But even that little bank in Pennsylvania here in my backyard was deemed too big to fail, and all the uninsured depositors got bailed out. They showed us how spineless they are in the blink of an eye. And then most recently, guys, we had another spineless jellyfish of a central banker in the form of Japan. You guys remember last Monday, right? The absolute anarchy of Monday morning. The Japanese stock market had its worst day since Black Monday in 1987. They lost 12.5% of all of the value in their entire stock index in Japan. The Dow opened down 1,200 points on Monday morning. And coincidentally, none of the stock brokerages worked that morning. Isn't that funny how that works? Oh, sorry, technical difficulties on the day that everybody wants to sell. Disregard that. I'm sure there's nothing nefarious going on there. But on Monday, August 5th, the global carry trade is unwinding. Here's why it's a brutal force crushing stocks worldwide. Stocks plunged down on Monday, and market pros say a lot of it has to do with the global unwind of the yen carry trade. The carry trade refers to investors borrowing money at near zero interest rates in Japan and then redeploying that cash into higher yielding assets around the world, such as stocks and bonds. But after the Bank of Japan unexpectedly raised interest rates 15 basis points, 0.15%, amid the prospect of rate cuts by the Federal Reserve, the yen has strengthened, and that sparked a wave of margin calls, leading to speculators unwinding their positions and selling stocks. And this was a global sell-off. It was Michael Gayed's global margin call scenario. Everybody was getting margin called. U.S. tech stocks were selling off. European stocks were selling off. Japan stocks were selling off. The yen was rising dramatically in value. And what happened? Well, the Bank of Japan came out. By Tuesday morning, they came out and said, Bank of Japan won't raise rates when markets are unstable, the deputy governor says. Now, think about this, guys, about how spineless this is. They raised interest rates twice this year in Japan. First, from nothing to 0.1, and then from 0.1 to 0.25. All right. So raising interest rates from nothing to 0.25% was enough to cause the most catastrophic sell-off in the stock market in Japanese stock market history. I think only one day was worse. This may have even been worse than Black Monday in 1987. I'm not sure if it was that bad or not, but it was close. All right. So raising rates from nothing to 0.25% causes a blow up. And the Bank of Japan comes out the next day and says, we're done. We're not going to do it anymore. Don't worry, guys. Bank of Japan Deputy Governor Shinichi Ukita said on Wednesday that the central bank won't raise interest rates when financial markets are unstable. Don't worry, guys. Don't panic and cover your yen carry trade. We won't do it if there's a sell-off. And it got even worse. Ex-BOJ board member rules out another rate hike this year. Central bank may be able to hike once by March. This is according to an ex-BOJ official. So not only are they not going to do it while things are unstable, they're probably not going to do it much at all for the next couple of months. The Bank of Japan won't be able to raise the policy rate again this year, given the market turmoil that followed its recent hike and the low likelihood of the nation's economy seeing a rapid recovery, according to a former board member. They won't be able to hike again, at least for the rest of the year, former board member Makoto Sakuri said in the late interview on Friday. It's a toss-up whether they can do one hike by next March. All right. So they raised rates by 0.25%. The market freaks out and they say, no, we won't do it anymore. Maybe by March, we might raise a little bit more. So the Bank of Japan, they are spineless as well. So all three of these events, guys, the yen carry trade unwinding, highly deflationary. Bank failures in the United States, highly deflationary. And also the UK gilt crisis, highly deflationary events. All right. So right now we have had three. If these things had been left to their own devices, these could have spiraled into massive deflationary events. We didn't let it happen. All three central banks stepped in within a matter of hours and inflated them away. All right. So think about what Michael Green said in Melody's segment. Yeah, we've got these Great Depression impulses, but the central bank's response is going to be to inflate them away. Now, also consider this, guys. Remember what caused the gilt crisis? They said it was Liz Truss's unfunded tax cuts, right? That's what spiraled out of control and caused the gilt crisis. Well, what happened to this? Son of a gun. My article. There we go. Oh. All right, it's not gonna let me do it. Stupid Benzinga's paywall. Trump and Kamala are trying to one-up each other with their tax cut proposals right now, getting rid of the tax on tips, and Trump wants more tax cuts for corporations, right? Look, I can get behind lower taxes. I am a taxationist theft kind of guy, and I want taxes to go down. I hate taxes, but you have to cut spending when you lower taxes, and nobody's even talking about cutting spending. Cutting spending is not even on the ballot in the United States. And Donald Trump is saying, I'm going to do exactly what Liz Truss did in the UK that led to almost the pension plans failing in the UK. And Kamala Harris is over here just totally drunk. Hold my beer, Donald. Cackling her way over there. And now she's going full communist, saying price controls, everybody gets a pony, $25,000 for people to get a free house, right? All of that money is going to come from the bond market. They're not going to cut spending to offset that. They're going to borrow more. So what I'm saying is we're steamrolling towards another deflationary crisis here in the United States. Japan is steamrolling towards one. China's in one. The UK almost had theirs. And we're still all doing things that are making it worse. And do you have any wonder why gold just closed at an all-time high on Friday, $2,506 an ounce for the price of gold? Because the world knows inflation is going to come roaring back. And the reason it's going to come roaring back is because we're going to have a deflationary crisis and our central bankers are spineless. They're going to try to inflate them away. And that is why these are spineless animals.
That was rough. That was rough, Melody. You want me to go first or you want to go first?
You go ahead.
Well, I mean, reading that really, it makes me so frustrated because it's just another reality, Jack, of how the people on the bottom are just getting clobbered and bamboozled by the upper elite. But I will also say that pensions are already insolvent, probably a little bit because of the Fed manipulation. And also what really drives me crazy is, I mean, it's just, again, no matter all around the world, is the human nature. These elites are going to do whatever they can, to protect their position, and it's really frustrating. And what I see, Jack, is this shows me that really what needs to happen here, and I'm pretty sure I'll get hate for saying this, but the rich people, like someone was saying, need to lose money. I say that what we do is we take their money from their stocks that they own and their ETFs and we fund pensions. I say that's what we do. I mean, because look, I mean, again, the saying in the Bible, it's harder for a rich man to get through the gates of heaven than it is for a camel to thread through a needle. There's a reason why it says that. It's warned us 2,000 years ago. It warned us of the elite and the rich. And if you look at the comments, I mean, what do the rich do to give back to society, Jack? I don't see any of that. I see egos. I see spend to the end. I see just buy, just spend. They don't give back to society. So look, why do we keep bailing them out?
I try not to buy too much into class warfare. All right. Like when I say the rich, there's a lot of very generous rich people out there who give people jobs, who give away huge amounts of money, who do very productive, good things with their wealth. All right. But that's not who's bankrupting these pension funds. That's not who's running these private equity funds that are losing or looting hospitals. All right. I mean, there's two different kinds of rich. There's people who use their wealth for the betterment of people around them. And there's people who use their wealth to just steal more from poor people. And I think it's important to draw a line between the two and not use phrases like the rich, which ropes those philanthropists in with the vampires. But at the same time, we have to face facts about pensions. That money is gone. It's already gone. All right. So when we're talking about like, well, yeah, we should have saved the pensions in England and everything. You don't understand, guys. There's no saving those pensions. A pension is a IOU from somebody who has already lost your money. It's gone. Now, the only thing they can do is inflate away the currency to the point where they pay you back nominally. They can give you the number of dollars they owe you, but those dollars won't be worth spit because they have inflated away its value. Well, that's a default every bit as much as a deflationary default. The only difference is with a deflationary default, like if we would have just let these crises play out and let the free market reset, people who have acted responsibly, who had savings and who didn't leverage themselves up to the hilt, they would have been rewarded for their good behavior. All the people who were up to their eyeballs in debt and the people who sold all these derivative products, they would have been wiped out. And of course, they're not allowed to lose money. And so we just inflated them away.
And of course, I was over exaggerating, right? I'm just sick and tired of these guys with these huge egos acting like they understand what normal people are going through when they themselves are not happy people. They're not helping anyone at all. And I'm just going to say this, and I am joking. Let's take their money, man. I want to take their money. I want to fund these pensions. I'm being facetious. Calm down, everyone. I'm being facetious. But I mean, I'm just sick and tired of it, man. I mean, that's what I'm really trying to say here. Half these people are rich because of this, the Keynesian type of economy we've had for the last 20 years. So it's that socialism that helped them get richer.
Yeah.
I don't know.
Yeah,
man.
the people who manage those UK pensions, for example, the people who were speaking at conferences about how liability-driven investment is this greatest thing since sliced bread, and how, oh yeah, our pension is now fully funded, and now we're diverting billions of dollars to fighting climate change with our retirees' money. And then a year later, they got their hand out to the government for a bailout because they weren't smarter than everybody. They were just on the right side of a trade that was created by ever dropping interest rates. And then the second the market turned against them, they were instantly insolvent. So they're not smarter than everybody else. They're just bigger dirtbags. That's what it comes down to.
Okay, I think that's fair. Melody?
Yeah. Just quickly, I think it's interesting, Jack, looking at, I think both Travis and I really think that if they hadn't, bought the F input with that loan facility, that home prices would have come down. And your friend that you always say has been right on the housing market would have been very wrong. And why I would argue that, they are not going to be able to inflate shelter again. It's because it's shelter, and you can see what's happening in China. And if we get to a point where inflation starts coming back, I don't think it's going to be in the housing market, because we simply cannot afford these prices, and we're entering into a severe oversupply situation. So I think that this is a great example of why market dynamics have not played out in the housing market.
And Mel, the one thing I would caution about, I agree with you. Home prices, there is this incredible, almost like black hole level gravitational force pulling home prices back down right now. But there's another giant black hole of easy money pulling them in the other direction up. And look at communism. And what just came out on Friday.
But it'll lead to social unrest. Oh, she would have to get those things through.
Social unrest benefits them. Are you kidding me? They're always encouraging it and calling it mostly peaceful every time there's social unrest.
Well, I just mean that, I do not see how the only way is that we would have to have a wage price spiral as well. And with the immigration headwind, and I think they're going to stop that, that there is a potential that you're going to have increases in wages. But I think we've done so much damage already. We will have to live through this deflationary event.
I can give you a mechanism in a sequence of events of how this could play out, right? Let's say hypothetically Kamala wins and she keeps her promise and she does this $25,000
first-time homebuyer grant.
Yeah. Mm-hmm. So what's that $25,000 is going to do? It's going to go out and start chasing houses. And so home sellers are going to say, I can raise my price now because now this kid's got $25,000 of a down payment. So yeah, you're going to get your money, but it's just going to start chasing the same number of houses. And of course, hold on, let me finish. Let me finish for a second. I know I'm talking a lot. But where's that money going to come from that Kamala is going to give the $25,000? She's going to go to the bond market and borrow it, right? And what's the bond market going to do when she starts trying to borrow trillions of dollars to fund this stupid program? The bond market's going to freak out because it doesn't have enough liquidity to supply all that. And so interest rates are going to start rising. And we're going to get firms blowing up, like with the UK gilt crisis, or we're going to get a carry trade unwind or something like that. And what's the Fed going to do? They're going to monetize that debt. And the Fed monetizing debt leads to consumer price inflation. I mean, it's stupid, this entire sequence of events. It's a series of all wrong decisions. But how did we get here? A series of several consecutive wrong decisions. So,
well, the other thing, though, we also got here because of narrative and overspending and tricking the public, which is what she's doing with that program, Jack, because it's already been here. In fact, we already have money.
This is
and
not
programs
even a new program.
in my city that offer
$5 billion,
more than 25.
Jack.
More
$5
than
billion
25.
we haven't spent,
More.
and it's every single state has it, and there's a schedule that the Treasury does. It shows you how they haven't spent it. They have already tried. We are at such a point of unaffordability. The only way we get home prices are sustained is if our wages meet home prices. That is it, because that intervention is not going to do it. It's just, I mean, you can look at China right now, especially as the boomers are retiring. We've got 15 million vacant properties. The boomers are retiring, selling, are unfortunately dying. This inventory is coming to market. And that is when I think supply is going to take control. And this intervention they're trying to do it's not going to work.
I agree. It probably won't work. But what if, let's not dare them to make the numbers even bigger, because maybe 25,000 is just the first pass, right? The bank term funding program, we were all in shock when they rolled that out and they said, here's this new $25 billion program. And
we're watching it
was
fail right now, though, Jack. We're watching it fail. I mean, because essentially they could get this money today in those down payment assistance programs.
It's pain deferred, right? The pain didn't go away, but it did prolong the inflation crisis. It did kick the can a little further down the road. It did increase the money supply. And, you know, it's the 2020s, and let's just not.
Right.
Let's
but
not
look,
dare them
we
to
have
do
the
even worse.
lowest June in 25 years of home sales, and that money is out there. We've got lower mortgages than were given out in the GFC. That I cannot emphasize. I mean, we just hit a 39 on the home builder survey. The people can't. They could go get that 25,000 today. They still cannot buy these homes, and so that's
rates,
what
Melody.
Yeah,
tell them about rates and how rates have already been 3% and 4% with new homes, and there's still prices are
exactly.
crashing.
Their prices are crashing, and they're already. I mean, UW, United Wholesale's got a 1.99% something out there that's backed by FHA. I mean, there are so many of these low down payment programs. You don't even have to put 3%, 1%, whatever. That all of that has been thrown at this market for the past 4 years. It's not working. It's not working.
1.99% right now with Lennar. This is in Houston, keep in mind, because it's bifurcated. It's bifurcated. But right now, Lennar's offering a buy down program maxing out at, looks like 3.99.
Sponsored by the FHA, guys. That's an FHA program. So it's already happening. They're already trying. It's not working. The 40-year mod, exactly. That's not working either. People are defaulting on it. We simply do not have the wages to sustain these prices. And so, Jack, I hear what you're saying, and I listen. There's a probability you have to assign to all things, but if we don't solve this shelter situation, the pitchforks are coming out, and people. It is such an unaffordable level. People are going to wake up to their agency because we are the majority. We are the majority.
Do you feel like the majority, Jack, right now?
No,
very
I don't
passionate
about
that.
And look, guys, I am not a housing bull, right? I'm just saying, in this decade, let's not rule anything out. Here we are talking about price controls at grocery stores in America. Yeah. Maybe 25,000 isn't enough to sustain this bubble. I probably agree. And when 25,000 isn't enough, they'll make it 100,000. And these idiots will go to 1 million if they have to stay in power.
I think we have 100,000
They won't
already
stay in
California.
power. They won't stay in power if they do
I
it.
hope not. I hope not. But
Yeah.
I think California has a $100,000 down payment assistance program, and
Yeah,
it's
they
an
do.
equity share, so they already have that.
They do all this exists already.
California is on the ballot, guys. I got news for you. You know that, right? I mean, we're talking peak California is the option, and she's doing okay at the moment. It's a pretty even race. California could be policy this time next year.
All righty.
Oh,
well,
shit.
I left Cali, dude. I don't want to go back, but let's move on to the next thing. Let's just end this up, round table it out here. And then I just wanted to ask the question of this. Dang, that got me upset though, Jack. I'll be honest with you, man. It got me so upset, but let's just talk about is the recession canceled, Jack? Let me just throw some stuff up for the viewers real quick and settle myself down. Here's the deficit. This updated. We're at 1.5 billion. Sorry, billion. I'm in 80s, baby. I apologize. Trillion. $1.5 trillion in deficit spending. This is just for the fiscal year. Good economies don't have this, guys. Okay, that's well known. Good economies don't have this type of deficit. But I will say the reverse repo market, Jack, right? Is the recession canceled? Look at the reverse repo market. The money's stuck, Jack. It's like they have so much money, Melody, that they printed. They cannot release it. Like the government's printed so much money. They still have it, but they can't get it out to us except through fraud and things of that nature. So it's frozen. This money is frozen in here until we have some type of event happen, and then it should go down again. But anyways, 10 and the 2, more inverted, 17 basis points. We almost hit it, guys. You guys remember 2 weeks ago on Monday, we almost hit an inversion, but we are now more inverted. It's a huge indicator of recession. I will say also what's interesting, because are we not going into recession? Look at the market's expectations, Jack and Melody, of the inflation rate. I mean, we understand the market is an emotional mess. And I just wanted to say it's important. The last time the market had these types of inflation expectations was in 2021. So at least they're making some progress in my head, right? But again, whose expectations are these though? That's what I have a question. Who's answering these census questions, the surveys? But anyways, guys, another thing that I thought was interesting is the employment numbers and job numbers that came out. 314,000 jobs terminated this month. That was temporary jobs. They're completed. They no longer have these jobs. Also, I think that's very interesting to point this out because, again, the economy is great. The labor market's great. And I'm saying, no, it's not. Mainstream is hurting. I'm doing everything in my power to budget, and I'm still barely hanging on by a thread. Part-time, okay, this is part-time jobs that were created in last month for economic reasons. 346,000 in one freaking month. 346,000 more Americans had to get a second job just to afford to live in the economy. And look at the numbers. The numbers are up year over year, 500,000. And the economy is doing better. If the economy was doing great, then people would not have to get a part-time job for economic reasons. That would mean we would have less part-time jobs because we're flourishing, right? And so there's that. There's a trajectory of the unemployment rate that looks like it's going up. Would you guys agree? Is that trajectory going up? Okay, well, that doesn't happen unless we're headed to a recession. So, I guess really the question is, starting with Melody, Jack, you need to calm down a little. Okay, I'm still frustrated. I mean, not at you, Jack. It's just like I'm frustrated at the whole system, man. The whole system, starting with elderly down, all the way to children. I'm frustrated. Melody, is the recession canceled? The stock market's probably near a new high. Is it canceled?
No. That's all I have to say.
Wait, what did you say?
I said no. I'm just kidding. No, I think, as I've talked about here before, like whether somebody at some stupid agency calls a recession, the American consumer is struggling. And I think what you just showed, Travis, is an alternative data point that highlights how bad it really is that people are having to take on, additional jobs just to be able to feed. I mean, what was the number, guys, of the percentage of Americans that were worried about affording school supplies? Like, when you're using, as Jack was talking about before, buy now, pay later for food, there is something seriously wrong. And so, of course, some of that has to do with our doom spending. However, that unemployment number is going up. Property taxes and insurance, that's going up. Healthcare costs are going up despite what they say in the CPI. So people are getting absolutely crushed. And then if when we start to see massive job loss, as you know, we're seeing layoffs. Macro Edge does a great layoff tracker. We're seeing layoffs everywhere. We just saw Subway, just from Canada to Oregon, layoff, just close stores. Employees didn't have any notice, and they're not getting their final check. We're getting to that point where all this starts to accelerate. So whether or not someone calls a recession, we are definitely hurting. The majority of Americans, 3 out of 5, are hurting right now and think we're in a recession.
Jack, what do you think, buddy? And also, I still love you. Do you love me? Oh, he's muted. He doesn't. He muted himself, you guys. I hope he says that again.
You're
Melody,
okay.
Okay.
You're okay. Get you another energy drink. You'll be fine.
I ran out, bro. I got 2 empty cans right here.
Hey, can we share my screen again, Trav, for your recession question? Jim Iorio put this out on Twitter this morning. This is excellent. All right. For all the people who are like, hey, we're not in a recession. Well, the only reason we're not in a recession right now is because the government is spending 7% of GDP in the form of new deficit spending. We're spending money as if we're already like neck deep in a recession. And so that government spending adds to GDP. And so, you know, the Keynesians and the political hacks can look at GDP numbers and say, we're not in a recession. The economy is growing 2.4% or 2.5%. Okay, but 7% of that, so we would be like negative 5% if we weren't spending all of this new money. So, you know, and Jim Iorio puts it this way, which is a pretty good metaphor. Any economist who will explain the answer to this question: if the economy was good, why are we accumulating $1 trillion of new debt every 100 days? You'd be confused if your doctor said, you're now cancer-free, but we're going to increase chemo treatment to every 6 hours. And the chemo treatment here is that government deficit spending that is 7% of GDP right now. All right. If the economy is so good, why do we have to artificially inflate it so much to make it look that good? Somebody here is lying, and shocker, it's the government. Amazing how that works, isn't it? And that's my take on that. Yes, we're obviously in a recession. The only reason we're not in a technical recession is because they're fudging the numbers with the government statistic.
And I have a funny one if you want to bring mine up about the consumer on Twitter.
Look
Consumer is strong, and one picture, locked up spam, guys. And then John Smith says $6 phone cables are now behind locked glass at Walmart. I found out yesterday. Consumer is strong, guys. Strong.
They locked up the mystery meat. It's the best economy ever.
Best economy ever.
Is that real? They didn't really lock up spam.
Oh yeah, that's California, brother. Oh yeah.
What?
So
That's
Jack,
on the
California is on the ballot, but things ain't working out so well in California. So I agree with you that there seems to be a wave right now that she's kind of riding on, Kamala Harris. But I think let's also that's being overdone for a reason, right? That to try to teach us that she could win this. Let's wait and see what the next couple months actually kind of turn out to be.
By the way, go to any mainstream financial news outlet right now. Bloomberg, CNBC, maybe Wall Street Journal. I don't even think Wall Street Journal. And what is the biggest story right now? It's not the fact that a presidential candidate is pushing price controls at grocery stores. It's amazing what a total failure the financial media is doing right now, because they're so in the bag for her, because they just orange man so bad that they will give that a slide. All right. That has been done in Cuba, in Venezuela, in the Soviet Union. All right. That's where you get bread lines. All right. Because price controls lead to shortages, and shortages lead to rationing, and rationing leads to bread lines. We know this. This is not a right-wing conspiracy. This is fact. This is the laws of basic economics. And the financial press is giving her a free pass. Go check. Price controls at grocery stores is not the biggest story on CNBC right now, or Fox Business, or any of the other ones. It should be. Maybe Fox Business has it. Maybe the Journal has it. But the other ones, no. I mean, if they gave this half as much coverage as they gave a mean tweet, maybe somebody might learn something about economics for a change, but they don't even give it that much.
Yeah, I would just, there's a great book called The Forgotten Man by Amédée Schlase that goes through all the crazy things they tried to do back during the Great Depression. I would encourage people to read that because, you know, as Jack is saying, there's nothing new under the sun. These we've tried these things before. People have tried these things. They don't work, but they will try them. I mean,
they will try. They will see what happens. We've been talking for 2 hours and 40 minutes. Holy smokes. Let's I got 2 more questions for you guys. We'll get out of here. Jack, we got this comment. It's fair. And they're like, but Chinese people cannot own land. Jack, do we own land here? Do we own the land under our houses?
I think the origin of this comment, and I don't mean to put words in your mouth, Eclair, but I believe you're referring to the fact that in China, you never really own the property. You just lease it for like 100 years, something like that, right? I may have the number wrong, but you don't actually own it. You just lease it, rent it from the government. All right. Now, in the United States, you own it, but you still got to pay the government. We call it property taxes. It's the same freaking thing. And over the course of 100 years, I bet you're going to pay the full value of that land and then some in the form of those property taxes. So look, guys, you know, if you squint your eyes enough, it's feudalism any way you look at it. We all rent from our lordship, the government, one way or another.
Yep. Melody, I got one last question for you. I thought this was good. If you want another one, that's fine. But question for Melody. In a previous show, you mentioned the vintage 2021 had higher delinquencies. I think they're saying was higher. Those are in trouble now. Why is that when rates were relatively low in 2021?
Because it's not about rates. It's about affordability. And they bought, and then essentially, you know, they didn't realize that their insurance was going to go up by 4 times. They didn't realize that their property tax, even in California, where you have Proposition 13, if you bought in 21, 22, you still have supplemental taxes. And as that home value was appreciating in 21, 22, people were not prepared for that first year tax bill because they looked at what somebody paid 2 years ago or last year. And so they are, and they bought at the time of those high home prices. So essentially, and probably with very little down, you know, but essentially their expenses have just increased exponentially and they don't have a ton of room. But Travis, I know you love this. What's your take on this question?
On this question, I mean, you knocked it out of the park. If someone, it's all on consumer sentiment. It's how people are spending their money. If someone in 2021 has a 3% mortgage rate and they freed up some money, you know, some spending money, then they may have went out and bought a 2021 car, a 2021 jet ski, a 2021 truck, which inflated their cost of living. So it's just one big mess right now. Just because you have a low rate doesn't necessarily mean that you have an affordable life. It should though put you in a better situation than when someone buys now, but it has to do with us. It has to completely do with us. Just because I have a 2% rate, maybe you have 5% rate, doesn't mean you're better than me. So yeah, that's all I have to say.
It doesn't matter how low your rate is. If you lose your job and you don't have any savings, you're not going to be able to make your house payment, and unemployment is arising.
Yeah.
Before we get out of here, any final statements you want to say, Jack? I almost said last words. That's just bad karma to say that.
No, I'm good.
Melody, you want to take us out of here and give us some last words when you're ready?
Sure. No, just once again, everybody, we thank you so much for the support. We thank you for joining us on a weekend when you could be doing all kinds of fun things. We couldn't do it without you. And so we'll see you again next week. But please always remember, math actually matters.